Okay, so I should be live now. We should be live. Okay, everybody. All right, welcome. Thank you for joining us on this fine Sunday. And today, the point of this video, as you probably already guessed, is that we are going to be talking to you. And now, granted, we're not supposed to give financial advice. However, we can help in general. We're going to be talking about credit card debt, especially considering what's happening right now in the economy. A lot of people right now are facing different types or different amounts of credit card debt. A lot of people are facing student loans. And for the most part, those things are in some ways very, very similar as far as how they're structured and how they affect you and how they affect your personal profile. So we're going to be talking, as you know, it's me, Big Truck, and then you see Michelle, who came and joined us before, and we were talking about Warren Buffett style investing, and we were focused on dividend paying stocks. This was during, I believe, the height of the crypto market, which, as you saw, has cooled off considerably since then. And we were focused on dividend paying stock and building wealth, even be it at a slower pace. We were focused on building wealth overall. So we are talking today about reducing your credit card debt, managing your credit card debt, and building yourself a better credit portfolio so that ultimately down the road, the purchases that you need to make through finance or through lease will cost you less money. Michelle, would you like to say anything before I continue?
Yeah, totally agree, John. Thanks so much for that intro. And before we get started, I know last time some people thought I looked a little stiff, and I'm still trying to get better at engaging with the audience. So I'm trying my hardest, but I also want to just say, good job, Team USA, in bringing home the most golds at 39, and also bring home the most medals at 113. So yay, Team USA! I hope everybody enjoyed the Olympics as much as I did, because I'm a huge sports person. So to me, it's always amazing being able to watch some of the greatest of all time, like Kevin Durant or Sue Bird, or a lot of other amazing players who were able to do really well as bring light to new issues that, although they're not super new, there are issues that people like Michael Phelps and Simone Biles have been talking about. And we want to make sure everybody is mentally and physically healthy. And I'm fully supporting everybody who wants to do sports. And so if anyone out there is a sports fan like I am, I hope you'll show your support. And if you're rooting for other countries, that's awesome too, because the more that we have diversity in the world, that's an even better thing. So go everybody. I'm so happy for all the Olympics, and go America.
Michelle, who have you been following most? Who's your favorite Olympian thus far?
Might be trying to think who I like the most. I kind of want to say Sydney McLaughlin. I think she's badass.
Okay. All right.
And part of it's because she's from New Jersey, and I think it's her first time, or maybe among her first time, winning gold. And the same thing with Ating Mu. Like, I think that it's amazing that they both won gold, and they're so young and have a bright future ahead of them. So I just love their accomplishments, and all the accomplishments of so many of the Olympians.
Yeah, they've been doing a very good job, especially despite the fact that we have like extreme heat and humidity in Japan. And I read that story, and I've heard that a lot of the performances may have been in some ways hindered by the fact that it's so hot and unbearable there. Yeah, they've been doing the best that they could. They've been trying very hard, and I'm really proud of all of the Olympians, not just the American ones. But I'm really, really happy to see that we can come out of COVID with something like this, because normally they would have just canceled it, and I'm very glad that they did.
Yeah, it definitely is like the person who closed the ceremonies. I think he said it brought a message of hope, which I think we all still need. I mean, I think like the whole world economy is not yet totally out of the woods. I mean, now we have another variant to worry about. So I know it's still a little tough, but I'm glad they were able to have it and still be able to show how much these athletes have worked so hard and how much it means to a lot of their countries, and to be able to accomplish things that they never thought possible. So,
Oh, can you guys hear me? I suffered a little internet issue. I'm coming right back up, but I'm pretty sure you guys can hear me right now, right?
I hear you.
Okay, good. All right. So the first thing that we were going to talk about was we're going to talk about credit card use in general. So before I start pulling up the charts and whatnot, I'll ask you, well, especially while I'm rebooting, I'll just ask you, how do you personally get ahead in the credit card game? So let me just unpack that. What are your favorite cards to use and why?
Well, my two favorite types of cards to use are a cashback card and a travel rewards miles card. So between those two types of cards, I get probably the most amount of benefits, and that's where I'm going to start with because I know you have plenty of more questions. And I know you're there, John. I think you're rebooting a little bit. Maybe
Oh
so
yeah. I'm sorry, I turned my mic off. Yeah, I'll be right back up. So okay, um, and your favorite card companies that you're using right now? Do you now? I know you use Apple products. Do you have Apple Card?
no, I don't. So I'd actually be curious to ask you about that a little bit.
Okay, I can talk a little bit about that. Now, as far as traveling, which card do you prefer for points?
So traveling, I tend to use United just because I'm accustomed to using that, and it happens to work out generally in my experience and using Chase as a bank. But I know there's other plenty of programs, like I've used American Airlines with Citi in the past, had American Express before. I've never done Capital Ventures or Capital One Ventures. I mean, so that one I'm not as familiar with, but it seems like a lot of people might like that too. And who can forget Samuel Jackson's, like, what's in your wallet, and kind of like what rewards are you getting? I'm pretty sure he's representing Capital One's venture, or if not him, then that other lady who I'm blanking on her name, but an actress lady who represents Capital One too.
Okay, so most of the people who follow me know that I use Capital One and I use Apple Card. Now, to tell the truth, I've been experimenting a little bit with Apple Card because of the fact that Apple Card never. Well, in fact, let's understand. Apple Card is actually a Goldman Sachs Mastercard.
Mm.
Apple itself doesn't make a credit card. Goldman Sachs makes the card and the financing behind it, and Apple makes the actual product that allows the card to function. So it's a Goldman Sachs MasterCard. Now, I have been using it for some things lately because I figured what I would do is I would try to test out their reward system. Apple's into direct cash back for all payments, and they give a discount considering the fact that all of their devices are marked up anyway. They give a discount on individual purchases of whatever you buy, but there are certain things that are very, very specific that they'll give even more of a discount on. And if you buy Apple products, you get a larger discount. Like if you buy an iPhone, an iPad, an iMac, you get a larger cash back bonus almost immediately.
Oh, really? Like how much?
Well, what I'll probably do is I'll show it on my phone. I'll show the breakdown on my phone. So basically, let me start out with this because this is the thing that I usually talk about when I start talking about credit FICO scores. So let me pull this one up. So basically, most people right now want the credit score that I have. In fact, they want the credit score you have too. Anything that's over 800, that's what they're looking
Yeah,
for.
exactly.
Let me pull this up.
800 Club. I want to make like a simple
Everybody wants to be part of the 800 club.
800 Club.
Now, the question is, how do you get there? How do you get to the 800 club? Now, I will say this. My personal strategies for getting into the 800 club and staying there, because believe me, it's not hard to it's not easy to keep the score perfect, because sooner or later you may want to make some type of change financially. You may want to buy something, and it's going to affect your score, especially if you finance it. The thing about it is, an 800 is a great goal to have. But once you get past 760 or 750, it really doesn't matter that much for certain types of loans. If you are buying a car, anything past or high 700s, anything higher than 720, you have an auto adjusted score typically, which basically gives you access to top tier financing at the lowest interest rates that are available. Now, it gets a little bit more complicated when you want to try to go and buy real estate. You want to try to go buy property. And the reason why is because now what they're more interested in is your credit history, and they're interested in your job security. And when I say job security, they are interested in making sure that you have a job, that you've had that job for a long period of time, that you've had steady income, that you've had income that's gradually been going up, because they don't want to see stagnation. They're also, as you can see in this little corner right here, they're checking what's called your debt to income ratio. Now, what is the debt to income ratio? I'm going to stop sharing this screen and I will share the next one. So what is your debt to income ratio? It's actually very, very simple. Your debt to income ratio is a measurement of how much debt you have compared to how much money you have coming in. So let me pull this up. Where'd it go? 1 second. Yeah, I'm trying to use these. Okay. Yes, your debt to income ratio is very, very simple. All you're doing is you take the amount of debts you have every single month and you divide it by your income. So what does that look like? Okay, I'll use small numbers. Let's say every month on your student loan, you have $500. Let's say every month on your car loan, you have $500. And let's say if you have a house or an apartment, you have $1,000. The total is $2,000 for the top, for the top portion. So if you have $2,000 up top and your income, let's say your income is $4,000. Well, then what you would be doing is you divide 2,000 divided by $4,000. Uh-oh, I heard an echo. 1 second, I hear an echo. Okay, so what you get is the number 0.5. And the reason why you get a decimal is obviously because the top number was smaller. Now, most banks are interested, before you try to buy a house or before you try to get loans, they're making sure your debt to income ratio is lower than 0.5. What they're basically saying is they expect you to be using less than half your money every single month in order to pay your liabilities. That's what it basically comes down to. Michelle, am I echoing at all? Do you hear anything bad?
Oh, you're good.
Okay, great. So if you have a debt to income ratio that is lower than 0.5, it makes it much, much easier for you to get, especially a home loan.
Yeah.
Okay, so if anybody doesn't understand something that I'm saying, please just make sure you put a comment there. I'd also like to remind you, please like the video if you haven't already. If you want to share this video with somebody who you know has bad credit or doesn't pay their bills on time, please share it. And if you're not, if you're new here, consider subscribing both to myself and to Michelle Marki, because she's always giving out great information and she's doing it for free, just like I am. Okay, so that is your debt to income ratio. I will tell you like this. We had a lot of politics behind the debt to income ratio because some of you may remember we had the Dodd-Frank Act, and what they were trying to do was they were trying to make it more difficult for people to buy a house or to even get a home loan or a mortgage if they had a debt to income ratio that was higher than 0.4. Now, a lot of that has been relaxed recently because this housing market, they're trying to get as many people in as possible. But the problem is the student loans. Student loans cannot be discharged. Student loans are generally pretty high. When you have a loan that's $100,000 and it's being paid off at such a slow rate, it hurts your debt to income ratio considerably. So most students right now, a lot of millennials, a lot of newer people who are coming in, Generation Z, they are accumulating student loans that are in excess of $40,000 to $50,000. Because if they go away to most schools are charging about $20,000, possibly $30,000 a semester. I believe the average that they have shown for student loan holding is about $40,000, between $40,000 and $80,000. If you go to school for 4 semesters, manage to graduate, chances are at that rate, you've probably got close to $100,000 in student loans. One of my friends' example, she has $100,000 in student loans. And that's not even that odd of a number, because what you're talking about is not just paying tuition, but you also have to pay meal costs, and you also have to pay all those other fees, and then you have to pay dormitory fees. So if you're going away to school, chances are your dormitory or where you're staying costs more than the school itself.
Or you might save more if you actually live off campus. Like so many people, maybe they live on campus the first year or two, but then a lot of people I knew moved off campus by junior and senior year to save money on dormitory costs so that they didn't have as expensive as living on campus.
When I first was going to college, I had an opportunity to go out of state to school, and I kind of decided against it. And it wasn't because of the money, because back in 1999, we weren't really worried about student loans. Nobody was thinking about it at all. So the thing that stopped me was the fact that there were no dorms left for the male students, and they were saying that you would have to live off campus. You were going to have to rent an apartment. So if I had gone away to that school, chances are I probably would have only completed half of the degree. I would have been neck deep in debt, because I would have been paying to go to the school. That was like $10,000 every semester. On top of that, the tuition would have probably been another $10,000. I would have probably been $100,000 plus in debt had I gone away to school. I ended up going to a CUNY school, Queens College. I ended up getting a scholarship to go to Adelphi University, and then I went back. You went to Adelphi?
No, I'm just saying.
Oh, okay. You're waving. All right, but I ended up getting one scholarship, and then the second master's I got, I actually paid for out of pocket, because I didn't want to take out any more loans. So I spent $18,000 out of pocket. Now, most people who don't understand what they're doing when they're younger, they will sign off any paperwork you put in front of them. They'll sign any credit card. They'll sign off on any student loan. They don't think about the consequences later down the road. So the issue is, a lot of people right now, they have debt to income ratios that are well above 0.50, well above. And that's the reason why you now see the government trying to do things in order to ease the burden on them, because the government knows that you have an entire generation that can't buy a house, or can't a lot of them can't buy cars. They can't get a car loan because their BTI is way too high, and they would have no money left over to pay for the car note and the car insurance and the maintenance and the gas, because owning a car is very expensive. Owning a car is a mortgage in and of itself.
Yeah, it could be really expensive.
Okay, yeah, I'm sorry, go ahead.
Some people say it's the second most expensive loan type you'll ever have, which it's second after your mortgage or maybe your student loans, but give or take, it's among the top 3 of the types of loans a lot of people get. And I totally agree with a lot of things you're saying. Like, it can be so easy and tempting, and it's easier now than ever. Like, before, like some time ago, I remember sometimes credit card applications would send it to you in the mail, and then you'd have to fill it out. So like that act of filling it out maybe forced you to like kind of think a little bit more about the terms, because it's like in paper in front of you. But with like online easy screens to like just easily sign up for a credit card, like I can be approved for a credit card in about 5 minutes, like, and that's including the time I just spent typing away my info. And I mean, it's so easy to get locked into a new credit card. And it's funny you say all of this, because my newest video are 7 truths about money that I wish someone had told me about sooner, so that I could have gotten started with like investing and in my early teens as opposed to later in my teens. And I talk about some things that I wish I knew about regarding like education and school and the cost of tuition. And like, if people want to check out that video, I actually use an example, much like you said, where if you're paying $19,000 a semester between your tuition, room and board, and so on, and then that's $38,000 a year. And then by the time you know it, after 4 years, that's the same value as an average house in Ohio. So feel free to check out my 7 money truths I wish someone told me about sooner, and you'll get a lot about my feedback of what I experienced and some things that I would change about, let's say, when I got a car loan, like what I would do differently if I got a new car loan. And just because I can afford it doesn't mean that I should go for it. Like, it's so tempting to be like, oh, that car payment is only going to be $269 a month. But if you add that up over the course of a year, and then you add that up over the course of the life of the loan, that could end up costing you way more, even if you qualify for 0% APR or interest rate for the next 6 to 7 years. In general, still, you might end up paying more than if you just gotten, say, what I like to get is a pre-owned certified car and paid in cash, ideally. And also, you then can invest the difference. Like, if I had to choose between buying a $10,000 car and a $30,000 car, I'm going to get the cheaper car because I can invest that difference of $20,000 in the stock market, and I'm the wealthier for it. So that's why I think it would be really beneficial for people to do a little bit of a reality check of, is this realistic? Like, I know it might be really tempting. Like, I used to want to have a BMW 5 Series, as you'll watch in my video, but I realized, like, it doesn't matter. I can live by what Warren Buffett calls an inner scorecard, and that makes me feel much better about myself than doing anything else. Like, if people want to keep up with the Kardashians, you can do that, but you got to ask yourself, if you're really happy trying to keep up with these people who, they may live flashy lifestyles, but is that your reality? Or are you just trying to make your neighbors and friends jealous about something that, 10 years from now, you may be kind of shooting yourself in the foot because you could have been saving that money instead of spending it on materialistic things. So, to each their own. I'm not saying that everybody has to live like a pauper, but like, definitely encourage people thinking about what really matters to you in life and what truly makes you happy.
Yeah, and it's sad. It's funny you mentioned the Kardashians. Um, there's been studies shown that most rich people actually don't spend as much as people who earn a lot less. And the ironic thing is that rich people spend less money trying to look poor than poor people spend trying to look rich. When you look at people like Jeff Bezos, Warren Buffett, Mark Zuckerberg, when you look at these people, they're not dressed in solid gold suits, and they're not driving around in Bugattis everywhere. Most of them, it's like they try to appear to be regular people. They don't try to outspend each other for most part. So I think it's kind of sad that a lot of people who just recently come into money and a lot of people who don't have the money at all are trying to outspend the rich, which
Mhm.
it's
And also, if you think about it, I mean, you could look cool and flashy. Like, I mean, LeBron James, I think, has great style. Like, but I think a lot of times these celebrities, they get stuff for free. So, like, they're not even spending necessarily on crazy outfits and suits. Like, some of the designer clothing manufacturers will happily give people like LeBron James or Lady Gaga outfits for free, I'm pretty sure. And then, they can strut around with their outfits that all of a sudden people are like, oh my God, I need to have that. But then really, like, the everyday consumer is the one that's kind of spending for that expensive look, when really a lot of these people we admire are kind of like doing it on the cheap. So, it's amazing how they're sort of like mind tricks that advertisers can kind of play with everyday people. So you got to think about that too. Is like, I bet if some of these celebrities had to actually pay for all those flashy looking suits, would they really go for it? Or would they think, hey, I can invest my money way better in a different way and invest it smartly? Like, I'm pretty sure if we put some of these celebrities to the test, they would hopefully do the right thing with their money.
in fact, speaking of student loans, Michael Garrido, he just recently found out that his school was closed, and now he was asking me whether or not how should he go about moving forward. I think he needs to seek a loan discharge, and try to enroll himself into another school. His school itself was shut down. I'm not exactly
Oh,
sure what caused the shutdown, but it may have been COVID related. I don't know. Maybe he could type another comment about that. But yeah, I mean, it's also it's a shame that there's a lot of people who get stuck in student loans. It ruins their credit, and through no fault of their own, their schools have been either unaccredited or shut down.
well, and like it's so tough, and a lot of this is so hard to kind of like prevent because you had to have kind of realize what you're getting into in high school. So for any teenagers out there, like I know you're probably trying to figure out and juggle a lot of things. Like I know with like, doing Zoom school and doing like all kinds of extracurricular activities like sports or working at a job and on top of school and SAT and filling out FAFSAs and all of that. Like I actually talk about all this in my newest video too. And in spite of all that, you gotta realistically think about how much can your family really help you and how much do you got to shoulder yourself. And if you think about that, like let's say you end up having to shoulder a ton of student loan money, how much you think that might set you back in the future. So if you're hoping to save up for a house or a wedding or whatever some of your goals might be, think about how much if you take on this debt between the ages of like between 17 to 22, let's say, what that will affect what some of your financial options might be later on the line. So, like if you're trying to get married by the time you're 10 years out from school or from the time you started school, like so, let's say you're getting into college at 18, and then 10 years from now you think you're going to get married. So think about how much you actually need to save to afford a wedding, and if you want like a fancy wedding that's like 30 grand, how much that will cost. But then if you have student loans of another 30 grand, you are setting yourself up for 60 grand easily of expenses in the future. And that's not even counting living and car and other kinds of expenses you might take on. So really try to like write it down. Like I like using paper or Excel spreadsheets. You could also use Google Sheets. Like really think about the kinds of student loans that you might be taking on and how much that might set you back, because that was the deciding factor when I was helping my parents do my FAFSA. Like I realized that there's no way I could go to a private school. Like I got into a few of them, but like I was like, this is like ridiculous. Like I'll be over $100,000 of debt if I do that. And like, do I want that for myself? Like, no, I don't want to shoot myself in the foot for my financial future. So like sadly, I know it's hard, but another solution a lot of people do is they go to community college for the first 2 years and then transfer to a 4 year. And then that greatly helps save a lot of money because you're doing a lot of your general education courses anyway, usually in the first 2 years. And then maybe you focus on your final major courses like towards when you're in your 4 year university, let's say. But there's so many other options that people don't always have to do the most expensive thing just because of the prestige. Like obviously it would be super cool to go to like an Ivy League school, but unless you're getting a lot of financial support, you don't have to, spend that much money just to get a good education. And as we've seen with the pandemic, a lot of people are just doing homeschooling, and some people aren't going back to school because they realize like they can totally learn all the necessary skills they need to learn to get a pretty good job. So it's amazing how much like we don't always have to just go for college. Like I went to college and I have a master's degree too, but I'm not saying it's the right path for anyone. And I'm seeing, Michael, your comment now. So I'm sorry to hear that they lost accreditation and they were claiming to be some sketchy stuff. And I'm sorry that that's the situation, but I hope that there are certain governmental actions that you can take. Like, I don't know what are all the options for you, but I hope that between either the student loan administrators or some of the options about what to do. I mean, there has to be articles out there about this situation happening to other people. So I would encourage you to Google, what some of your options might be. And if anyone has been in this situation before, or if you know anyone who's experienced something similar about trying to get your student loans discharged, like maybe you can comment or share a little bit more, because I'm sorry that I haven't been in the situation, so I don't really know what it's going to take. But what I would suggest is keep fighting, because you are on the right side of, you didn't do anything to deserve this happening to you. So Just like, if you got scammed using a credit card, you should fight for what's right and fight to get your money back. So I wish you all the best and hope everything will work out for you, Michael.
Craig says the big problem is that they're asking 17 and 18-year-olds to sign on the dotted line and make a massive financial commitment when they aren't even close to grown up yet. I have a question for you, Michelle. Have you ever, with credit cards, have you ever put yourself into the quote-unquote hole?
No, I actually haven't, because I've never had an interest payment on my credit card. So I always had enough money to cover, even though sometimes it got really close. Like sometimes I put some of my school tuition on some of my credit cards, and that was pretty hefty. But even in spite of doing some of that, I always made sure I was going to have enough money. And there were a few close calls, but I managed to never be in the hole in any of my credit cards.
I'm just responding to Nick. He asked, will the replay be up yet later? Yeah, the replay will be up later. And by the way, Michelle, if there's anything from this video that you want to use, if you're making a video later, feel free to do so. So
thank you.
You have, like, what is it, oral and express permission or whatever they call it. Okay. As far as going into the hole, when I first got my credit cards, I definitely put myself in the hole, which now that leads me to the next thing that I'm going to talk about the breakdown of your credit. So this is what happened. When I was in school, I didn't understand credit cards, despite the fact that I was able to sign up and get them. I didn't understand how they worked. I don't feel shame saying this now because I fought my way out of it. But I thought that, or something about having a number of credit cards and something about having access to that kind of money makes you believe that the amount of money that you have access to in credit form is actually real money, which it's not. So I was walking around thinking I had $50,000. So the bottom line, I used to buy lots of gadgets and stuff, because keep in mind, this was the run-up between 1999 and 2007. When iPhone came out in 2007, it pretty much obsoleted everything else. But I used to be the one, I'd have BlackBerries. I had friends who'd buy Nextel phones, Sidekicks, whatever the new toy was that came out, we basically had it. We were running up bills sky high. We had phone bills. A lot of people ruined their credit back then because of Sprint. Because Sprint was offering, cool phones, especially Sidekick pagers, Nextels, Blackberries. So bottom line is I bought a lot of stuff. And back then, the issue, I think I had ran up about $15,000 worth of credit card debt. Now, I had a job. I was working at Circuit City. I was working at Best Buy later on because Circuit City went bankrupt. So I moved over. I went to Best Buy. And I was making my payments, but eventually it got so expensive because of the card. Like, revolving balances is what I try to avoid. I'm going to talk about that later. But it got so expensive that I ended up defaulting on cards. Like, when the payments would come, I'd basically default on it. And then, not understanding how it all worked, what I tried to do was I tried to consolidate the cards, because you know how every now and then you get a card that says, yeah, you want to do balance transfers? You can transfer the balance from here to this other card.
Yeah.
So when I thought I had fallen behind on one card, I balance transferred the balance to another card. And eventually the banks figured it out and they cut my credit off, and they cut them off one by one, leaving me just the balance to start paying back.
Oh, no.
So that said, yeah, I put myself in the hole. I dug myself out of the hole once I started working. Now, that brings me to, what are the aspects that they're looking at when they're looking at your credit and judging your credit? So the first thing, and these are all screenshots from my personal credit. I don't mind. I share them. But on-time payments. On-time payments are the most important thing. Mortgages, car loans, credit cards. If you make late payments on anything that has your social security number attached to it, Or if you ignore bills and they use your social security number to send it to collections and you start getting late payments, that seriously affects your credit negatively. I think by now everybody should know that you have to pay all your bills on time. What I started doing, and I explained this to Michelle, was I pay my balance every single night. Why? Because if I pay my balance every single night, it does not give me any opportunity to be late, number one. It also signals the banks that I have plenty of money where I'm not at risk. I'm not a credit risk. Okay, so I make all my payments, as you can see, 100% on time. So the next thing, what is your oldest credit line? This is one of the reasons why they've told you do not cancel your old credit cards. If you want to pay off a card, fine, but don't cancel it.
Mm-hmm.
When you're talking about oldest credit lines, they're looking to see how old you have proven that you are trustworthy with money. So it says mine is 19 years. So my oldest credit line has been open 19 years. I should also mention used car loans, new car loans, they also count as credit lines.
Right.
They are not as long. Oh, go ahead.
Yeah, sorry, just saying when you finish paying it off, like same with your student loans, those at some point fall off your score like history. So like even though there's still like a line item for the past, it at some point stops being factored into your score when you've paid it off.
Your credit history, they are watching your entire credit history, but ultimately the only thing they're really grading you on with their algorithm is typically the last 7 years. The only thing that I know is very difficult, if not impossible at this point, to get off your credit is bankruptcies. Bankruptcies and student loans. Student loans can't be discharged. Bankruptcies can't be discharged. So when they're watching your credit line, and Grant, I will say this: the last person, Craig, said that they're letting 18-year-olds sign up for credit and they don't know what they're doing. Unfortunately, it's important to start building your credit at 18. I've had friends that go ahead.
Or earlier. So like yeah, you asked me about one of my oldest credit lines, and it was probably a department store card, like at Macy's or something, through my parents. So as a teenager under age 18, I was able to start building credit even before I finished high school. So that's one trick, but like you can't go crazy. So if you're a teenager and let's say, it's probably every kid's dream to think and believe like, oh, my parents going to give me their credit card and I can go buy whatever I feel like. But like I knew that deep down I have a conscience, and I thought like I can't be reckless with using this credit card. Like my parents are trusting me. And even though I got to go on like sites like eBay when I was 13 years old, like, at the time, some time ago, like I thought that was pretty cool. But then I knew that I was on the hook for the money that I spent, even at age 13, buying whatever online. And like I knew not to be bad about using the credit, because I knew that this is money that doesn't belong to me. It's basically a short-term loan, and I owe someone, a bank, for that money. So I better like pay it back. And it's funny you're sharing this because I have a similar one also from Capital One that I could also share if you might want me to try to do a screen share.
This page that I pulled up, I screenshotted from my Capital One.
Yeah, and I actually used a similar one. Like that's why I know it's Capital One, because I've used a similar one in one of my videos about how to boost your credit.
If you want to share something with me, you request a screen share and I'll pull it up.
Okay, let me I'm gonna press share screen.
Yeah, and then when you push share screen, it'll show up and then I will allow it. Okay, so I'm gonna stop this screen and I'm gonna share yours. There you go.
All right. Do you see how I am showing this like 820 to 830?
You have 100,000 and available?
Well, it's
away.
In that range. I like change that slightly so that it wasn't an exact amount. So like it's somewhere in the neighborhood, but like I didn't want to like have exact my exact credit out there because I was like kind of, not sure. I don't know if people might get a certain idea, but like I wanted to just give an example that had sort of rounded, nice numbers. But this is an example of how, of some of the opening of cards that I've had over the years. And as you can see, I'm also like 100% payments on time, and that years of credit history is important to have, like older credit lines. So from when you're ideally, like as soon as you're able to open a card, like actually the interesting thing is a lot of credit cards don't have a minimum age that you can open it. So if your parent can trust you when you're like 12 and they let you, be an authorized user on their credit card, you could start building credit like pretty early in life. And maybe they don't really give you the card, but like let's say they get you as an authorized user, and then you use that card with your name on it at the grocery store sometimes or whatever. Like it's a way to start kind of having some credit be built up in your name, so that's good. And then I use this example of 1%. Like for me, this fluctuates. It can be like anywhere from usually 1 to 4% in my experience. And like, so as an example, like you want to have as low of a utilization rate as humanly possible. And
well, Michelle, these aren't your numbers.
These are my numbers. Yeah. Once upon a time, like the only, well, some of this like fluctuates a little bit is what I'm saying. Like sometimes there might be more than a few accounts that I opened, or like less accounts open. Like this was just a screenshot at one point in the last few years, with the exception of like I just modified the available credit so that it didn't like show the exact like specific available credit, but just I made it rounded so it didn't look like a weird number. And like recent inquiries, you want to have like as low amount of them as possible. So if you want to watch how I talk through these elements more, like feel free to check out my, pretty sure I called it 7 ways to boost your credit score video. And yeah, that's basically what I wanted to like kind of share is like, I'm very similar to you, John, in how we're trying to be responsible of our credit. And I want to say you're actually better than me because you probably have a 0% utilization rate.
Well, I will say this. In fact, I'll pull mine back up. The reason why I do probably have a utilization rate is because at least, let me see, is that me? Yes. My credit used at any given time was actually 3% because what happened was when I was living in China, I opened a credit card with my mother so she had access to send me money just in case I had an emergency. I never closed that account, and because I'm basically an authorized user or she's an authorized user, that account is still open. What she does is she'll spend on it, but she waits till like near the end of the month to pay a bill off. So what she ended up doing was giving me some basic recycling balance. I don't think they counted it very much against me, which is why my credit is absolutely perfect. So I'm guessing they didn't really count it against me.
Well,
But
the important thing is that you have utilization of less than 9%. So that's
yes,
what I found is like, as long as you're below 9%, and I noticed like my credit score bumps up like a point or two if it goes up a little bit. So like, for example, I'm gonna get dinged if I go up from 2% utilization to 4% utilization. Like they'll probably take off like 2 points, and not that it's like an exact ratio, but like they'll take off a little bit the higher my utilization is. So some months it's at 1%, other months it's at 3 or 4%, like whatever it is, it will like give plus or minus points depending on how much your utilization rate is.
right. And see, I guess to break this down for everybody as simple as possible, the bank wants to see, number one, they want to see that all your payments are on time. They want to see that you have an old credit line that's very old and that keeps getting old. So this way they can always look back over your entire credit. Then when it comes to these last four categories, they want to make sure that you have access to credit, but you are managing it very well. They want to make sure that you have plenty of access to credit, but that at any given time you're using less than 5% of all that available credit. So they want to make sure that if I have 41,000 available, or Michelle has 100,000 available, at any given time, they want you to be using less than 5% of it. And when you're talking about a number that gets very big, like 100,000, They want you to be using as little as possible, 3%, 2%. And ultimately, the reason why is because what they're making sure is that you're not supplementing your income with your credit. If there are people who, because they run revolving balances, they purchase a lot of stuff on their credit card that they couldn't afford, and they do it because they were running out of money near the end of the month. And once they get their next check, that's when they pay back the credit.
Mm-hmm.
The problem is the banks can see that, and they can see the pattern. And then they realize it's like, wait a minute, you're not making enough money. You're using a credit card to supplement your income. So you're not as credit worthy because basically you're on the edge.
Mm-hmm.
You're a person who's you're a credit risk. So the banks will reduce you. Now, as you can see, I had new accounts because I had purchased a house within, say, I think it was like 2018. I purchased another house. Recent inquiries, I'm pretty sure that came. I had to, at one point, I had to do work on a place. I had to buy a new oil boiler. So I'm pretty sure one of those came from there. But if you wait 2 years in between charging something else, those just disappear. So in exactly 2 years, where it says new accounts will disappear, where it says recent inquiries will disappear, and where it says, those will disappear. And what will happen is the one that says good will go to excellent. Now, as far as new accounts, I believe you're allowed to open 3 accounts every 2 years. Now, I don't recommend you do that because chances are you'd be opening credit cards that you would end up having to start using regularly in order to make sure they don't close. So you're allowed up to 2 accounts, but you don't necessarily have to use those 2 accounts. The fewer accounts that you have every 2 years, the higher your new account score is. For the one thing I like about Capital One and Wells Fargo is that they both break it down for you and they show you piece by piece. And if you are currently in a bank, your bank most likely has an app that allows you to access your bank account. If that is so, chances are you have a credit watcher somewhere in one of your apps.
Yeah.
You have to get familiar with it, and you need to learn how it works.
Yeah, like I think it's they might have like slightly different names, like Credit Journey or like the one for Capital One. I think it has like they call it like something slightly different. Maybe or no, they call it Credit Wise. So you'll see if you find like I think maybe for Chase it's like Credit Journey, and then for Capital One you should see something that says Credit Wise. So like a lot of these banks like to have their own little whatever they call it credit check, so that they give you a little bit of a window. And of course you can use plenty of other free ones like Credit Sesame and Credit Karma. Like back in the day, like you used to only be able to get like your free credit score report from like TransUnion and Equifax and Experian like once a year. But like there's been so many strides in making this knowledge like readily available through a lot of banks and through a lot of ways that are free, that like you should be able to know this. Like if you don't know what your credit score is right now, I highly encourage you to go check and just to know where you stand, and also pay attention to if there are any red flags. Like a lot of these apps give you alerts, like if there's something like questionable that's going on your account, and maybe it's not something you did, but like let's say this has happened to me once where somehow my email address is on the dark web and I have no idea, obviously how that came to happen, but every now and then my credit score thing will be like, hey, FYI, you have an alert that, watch out for this little thing that happened. Or if you have too many recent inquiries, you'll be like, heads up, this might be a little bit of a warning sign. Or, with the new accounts, John, I wanted to also mention that like, I think you can have a few accounts. Like I've had like probably 3 or 4 new accounts sometimes in the last 2 years, and it's totally fine, like not a big deal. But like where this has maybe affected people I know is like, let's say, you're at Home Depot and you're opening a card, and then you want to open like a travel rewards card in the same month, and then you're at another department store and you're opening that card. Like if you're just opening so many cards, like especially within a month or two, then they'll be like, nope, you're rejected. So like you you're less at risk of this being a big deal, the less frequently you open a new type of account. So just pay attention to that. Like, for example, if you're gearing up to try to get a mortgage, and not that I have one, but what I've heard is like you don't want to have like a bunch of new credit cards or a new car loan if you're just about to get a mortgage. Like you want to try to space some of these things out if you can.
Yeah, no, you're absolutely right. What I will say is this: if you start opening a bunch of credit cards, it signals the bank that you are trying to take out a bunch of new credit cards. And the bank may take that as a signal that you are financially unworthy or you're a credit risk. I should also say, when it comes to department store cars, and they've gotten me with that too. Like, I remember one Christmas, I decided to open up a Sears account, and then I opened up like a home. And the funny thing was, I was opening up cards, and I really didn't even shop in those stores. I was basically doing it because I could. Now, if you are a homeowner, yeah, you should definitely have a Home Depot credit card, unless you have another credit card that you like to use more. Because we're going to get into rewards points. We're going to get into rewards a little bit later. But my strategy is like this. Once you've decided what cards you like to use the most, it's probably best to stick with those cards and to try to build up the available credit on those cards as high as possible. So with my Apple Card, I recently got a request that said, "Hey, do you want a higher credit limit?" I said, "Yes." Okay, good. Then I got that same request from Capital One, and I said, "Yes, I'll take the higher credit limit." When they raise your credit limit, what that does is it helps your credit availability increase, and it also simultaneously reduces the amount of credit that's used, because as one number goes up, the other number stayed the same. Now, as long as you don't go out and start spending more money just because you had that credit increase, it helps your score. My goal is to slowly build myself up to about 50,000, because the reality is 30,000, once you pass 30,000, you have an excellent. No, I'm sorry. Once you pass 50,000, you're absolutely excellent. Once your available credit exceeds 50,000. As you can see, mine says 41,000 available, so it says good. I'd like to make each one of these aspects excellent. Now, as far as recent inquiries, there's nothing I can do about that one except wait. The only thing I can do is not open up any more accounts and wait 2 years, and then these two will drop off, and then I'll get an excellent there. As far as available credit, if I slowly continue to build my credit to 50,000, that one will switch over to excellent. So it may take me a couple years. However, right now I already have an 850, so there's nothing to really fight for at this point.
And yeah, I mean, yeah, the only thing you want to get is like the brownie points of seeing like you're excellent.
Exactly.
Whereas like, to me, I'm a little bit like annoyed that my oldest credit line is not old enough. And by old enough, it has to be like 25 years. So I would have to be like 40 something before my oldest credit line will turn excellent, which I think is like kind of weird. Like, why do you have to be like in your 40s and having something for at least 25 years before, it will be considered excellent? I think that's like a little bit too long for that one component to turn excellent, but like that's what I found. And also I want to say, John, like that's awesome that you were offered to get more available credit, like to increase your credit line. But another thing you can also do is like, let's say you've been with a card for some time and you're a loyal customer. And when I say customer, I mean like you're faithfully using that card, and you want to buy something. Like, so let's say you want to buy a new iPhone 12, and you know that like you want to increase your credit limit so that you can afford that, and like paying whatever that is, like $1,000+. Like, let's say you call up that credit card bank and you say, "Hey, I've been with you guys for a while. Could you please increase my credit line?" And they'll say, "Okay, let's take a look." So I think a lot of the time you have a pretty good chance of being able to increase your limit as long as you've been responsible and pay on time, and a lot of the good behaviors that you need to have with credit cards. You will have a good likelihood of them increasing your available credit. So like I would just put that out there. Like, don't be afraid to call up your credit card company and just straight up ask them, like, "Can you increase my credit limit?"
Yeah. You can call up the companies, but what I've noticed is, especially when you have the app, they will try to do it automatically. They'll just do it through the app.
Oh, that's good.
Yeah, Apple Card is good for that. You can request with Apple Card. You can because Apple Card, they try to do everything through text message. So if you have inquiries, you send a text message, they'll send one back. You don't have to call anybody. If you want an increase on your credit limit, you can send a text message. They'll send one back and say, yeah, we'll review your credit, blah, 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 and then they'll send it back. One thing I wanted to point out before we move on, Michelle mentioned the fact that there are 3 credit bureaus. Now, basically what this, in the very beginning of the credit system, supposedly the credit system was invented because there were farmers who wanted to basically take out credits, and they needed a way in order to measure how credit worthy these individual farmers were. Ultimately, that idea grew into these credit rating systems. There's TransUnion, Experian, Equifax. These 3 credit rating agencies have 3 different algorithms for calculating credit scores, so they're usually never the same. So even if you have bad credit, chances are you may have a 530, 550, 560, but they're almost never the same. Now, when you have good credit, as long as all of your scores are above 800, you're fine. You're perfect at that point. If as long as all of them are above 750, you're doing great. Now, what I'll say is the low score is usually not the score that they will base your loans on. They usually base it on the middle score. And in this case, the middle score is 743. Supposedly, they claim that using the high score is not fair for the bank because they're trying to make interest money off of you when they give you the loan. And using the low score is not fair to you because that just means they're going to charge you way more interest than they need to. So typically, they'll go after the middle FICO score. So if you're buying a house, they're going to pull your entire credit report. They're going to look specifically over your credit history and your job history because they're going to make sure you are gainfully employed and you are employed in a way where they don't have to worry about you losing your job. They will look mostly at your middle score. Auto-adjusted credit scores mean that if you're buying a car, because of the fact that it's less time and it's also a smaller amount of money, chances are those scores, even if you use Credit Karma or something like that, if you bring your printed credit score there, they don't care about that. They're going to need your social. They're going to need to pull your credit history. This is one reason why you want to be very careful about shopping for cars and letting them pull your credit history one by one, because if they do, they will drag your credit score down because they're adding to the recent inquiries.
Yeah.
So the best bank you can be a member of is if you have a credit union. A credit union, you can actually go directly to your bank, and even regular banks will do this if they offer it, but a credit union gives you low interest financing if you want to finance a new or a used car. So you can go to the bank, you can say, yes, they told me that this car is going to cost me exactly $3,500 or whatever it is, and they will print you a check and you will pay the credit union back rather than going to the automotive's credit like GMAC for Cadillac and GM or Ally or something like that. If you have a credit union, you can easily get lower interest financing from your credit union. Do you have anything you wanted to add about that?
Yeah, I've actually heard that credit unions tend to be easier to work with and have better financial options sometimes than your big concrete banks that you see on every corner. So definitely check them out. I haven't had to use a credit union yet. I mean, maybe if I got a mortgage, I might try to check out what some of their conditions might be and compare that to the big banks. But I think that a lot of people have had good experiences with credit unions. So I definitely think that's a good point you made.
Yeah, I had bought a Chrysler 300 SRT in 2012. And the dealership tried to screw me on it. I had good credit, but they gave me a 7% interest based on all the terms, right?
Whoa.
It was actually a funny story. What happened was I went to a Chrysler dealership. I made a video about this actually. I went to a Chrysler dealership and they had this black Chrysler 300, red interior. I really liked it. I asked the dealer, okay, what will you give me for my trade-in? Now, the Chrysler dealership, they didn't want to give me what I wanted for my trade-in. And what was so weird about it was directly across the street was a Toyota dealer. And I happened to see the tail, because it's a very, very specific car. And I happened to see the tail end of this car. And when I saw it, I was like, wait a minute, that looks like the exact car I'm looking for. So they had a black car and it had a black interior. So I go to the Toyota dealership and I inquire about it because I thought it was a used car because it was a Toyota dealership. I was like, yeah, Toyota doesn't sell these cars. Chrysler does. And I went there, found out it was a brand new one, black on black interior. And the Toyota dealership was like, you know what? We'll take your used car. We'll give you exactly what you want for it. And we'll put you in this new loan. What I didn't realize at first was what they were doing was they were setting me up for a high interest loan. And it was a 7% at the time, right? So this car, when I bought it from them. I let the entire deal go through. And I drove that car off the lot, brand new. I owned it. And I drove directly to my credit union. And as soon as I drove there, I was like, listen, I just bought this car. This is the paperwork they gave me. Can you do better? Within like 2 hours, they drafted me a better offer. They dropped the interest rate down to like 3%. I think I was saving maybe 20 or 30 or $40 or something like that. And I signed on the dotted line and boom, I was able, just because of the fact that I had a high credit score, I was able to go from one bank right to the next and say, listen, give me a better deal. And they were able to do that. The same thing also happens with houses. If you buy a house and you don't like the terms that you've gotten, you can refinance. And I will say this, with because of the fact that there's a lot more fees that go into refinancing, they are going to charge you money for it. However, in this current climate, nobody knew that COVID was going to cause them to drop the interest rates down this low. There are a lot of people who refinanced maybe 2 or 3 years ago, maybe even 4 or 5 years ago. And now that they see the interest rates at 3%, they're like, I'd like to refinance again. Yeah, they're going to charge you. You might pay between $4,000, possibly $8,000, depending upon how large the loan is and depending upon how many fees there are. But that $4,000 or $8,000 over a course of 15 or 18 or 30 years or whatever it is, in the long run, you'll make that money back. You'll break even within maybe 2 or 3 years. Did you want to add something on that?
Yeah, I think that's a great point. I mean, I agree that it makes sense to refinance if you can save more than what the initial terms were that you were getting. So, much like, I try to keep up with some of the Graham Stephan videos, and in one of his latest ones, he's like, if you plan to be in a house for 7 to 10 years, definitely get a 30-year mortgage and also refinance it if you can get lower interest rates. And I think that that's a great thing. Like, if you can save way more, like even if you initially might have had a 3.5% and somehow you can get refinanced down to 2.75%. And if you do the math and you calculate the amount of thousands of dollars that you could be saving, then it could be worth it, depending on, do all the math and see what are some of the pros and cons of trying to refinance. But it's amazing how much financial options there are if people just are willing to ask. There's almost nothing that's handed to us on a silver platter. So like they say, if you don't ask, you will never find out. So, you might as well ask, even if you're afraid or you think that you should have known this already. That's why they say there's no such thing as a dumb question, because if you really don't know, then why not ask? You should always try to find out if there's something better you could be doing and try to know all of your possible options in front of you. So that's great. I actually learned something new from you, John, that I never knew you could get better loan terms on a car loan. I just figured if you signed up with the first place, I didn't know that you could refinance that with another bank. So I've never had to do that because I've only ever had one car loan, and otherwise I've paid my cars in cash. But for knowing about that, like that's a great option if you don't want to have a 7% car loan and only want to get a much lower one, and you were able to get 3% because you had great credit. So that's a great win-win story.
And not only that, with the credit refinance for the car, there was no fee. There was no fees. I didn't pay a single fee. All I had to do was sign on the dotted line, transferred it from what was it, Toyota Financial, transferred it right over to Municipal Credit Union, MCU, and there was no fee. Now that doesn't work again. That doesn't work the same way with houses because there's title searches, there's appraisals. Like for instance, tomorrow I'm refinancing someone. They're getting an appraisal on their property tomorrow, and usually an appraisal is going to cost you about $500-600 out of your pocket. So there's a lot of fees that, yeah, if you want to do a refinance for a property, it's going to cost you definitely. However, what's $500 or $600 if you're saving thousands of dollars? And I'm going to ultimately, before this stream is over, I'm going to reintroduce you to the loan calculator. I shared it with Michelle, and hopefully she'll show it on her channel to her audience. And just to remind you, especially if you're new, because we had a couple new people come in. So like the stream, share the stream, subscribe to the stream, and then Michelle Marki's channel is Michelle Marki on YouTube. Let me see, share,
I appreciate
because
anybody.
Michelle is giving out great information for investors and for all types of financial advice. And the thing about it is she's halfway there. She's almost to 1,000 subscribers. So the more share, subscribe, the more people who sign up, the quicker she gets to 1,000. Then she gets to join community chat, and then she gets to give her information and do polls. And we're really, really excited for that. Okay.
I'm trying to help you all out for free, like a lot. And of course, I'm not a financial advisor. I don't do this professionally. All of this is because I feel so passionate about wanting to help everyday people. And I'm a lot like you. Like I came from modest means and I had to work hard to try to figure out my personal finances and how to invest. So I'm just trying to pay it forward and share what I've learned. And I think that it's been able to help me be on a good path toward financial freedom. And I feel confident about being able to realize my dreams for financial independence. Like I'm not there yet, I'm still working toward it, but I feel great about being able to financially thrive and not feel like I'm under the water with debt or anything. So I just want to help out as many people as I can. So if you want to learn about personal finance and investing topics, like I'm all about Warren Buffett and Charlie Munger. And even though they're 90-year-old old people and people think they might not be relevant anymore, I think that some of their lessons are more relevant than ever in today's time with a lot of what's been going on in the markets and the economy lately. So I just want to help as many people out as possible because I don't want us as millennials and Gen Z to become a lost generation. Like it's bad enough that a lot of my friends are set up with so much student debt and they're not able to always buy houses yet. Like we have it so rough. So I just think it's important to try to help each other out. And if you have any questions, like plenty of people send me messages at my Instagram, which is Michelle Marki. So feel free to hit me up there if you have any questions and I'll try to help you out. Like there's plenty of people here who I think joined John's live stream before. Like I remember you, Craig, and I want to talk about how you shared a comment about the amortization schedule being reset. But if you enjoy my content, if you feel like it's helpful to you, I'd love if you could please share it with your friends and family and people you care about. Like I even have a video about how to help mom be financially secure. And yeah, I just want to really help as many people as I can because I want us to all financially thrive. Because if we can be more financially secure and free in this country, we will be a lot better off. And you know, we can have what a lot of people are starting to give up on, which is like the American dream. And you know, maybe some of that's going up to Canada. Maybe Canadians are better able to have the Canadian dream, but I know that their real estate market is also a little hectic right now. But anyway, like I'm all about trying to help people out. So If you have questions for me, please let me know, and I'd love to hear from you in the comments of my videos, and any way that I can help you out with some of my personal life experiences, I'd love to help you out if possible. So thank you.
Okay. I will say that. Okay, so we had a couple of people who were saying thank you. Yeah, I'm going through these things as much as I can. Now, Aaron B. Who somebody timed him out, but I'm actually glad that he asked it. Aaron B. He's listened probably to a couple of people. I'd like to take him out of timeout. I just got to figure out how. The thing about it, Aaron, and I'm sorry you got timed out. So, guys, moderators, do me a favor. Don't time out people who are just asking regular questions. I'll deal with them. But the thing about it is there's a lot of debt shamers who shame people and they don't allow you to grow. The reality is you need a credit card. You need to build up your personal credit. There are some people who don't believe in credit. They think they're just going to pay everything in cash. Please wake me up when this person comes up with $300,000 or $400,000 in cash so that they can purchase a house, and then has to come up with another $100,000 so that they can beat the cost of inflation. Since we know that the housing prices have been going sky high due to inflation and due to the housing market being in extremely high demand because of corporations. In my opinion, there are certain things that, first of all, let's understand something. Cars are depreciating assets. We all understand that. However, you need a decent car to be able to get back and forth to work in many cases. I live in New York City. I don't like having to use the train all the time. I like having a car. I like being able to pick up my parents and go places. I like being able to go out and drive my car. I don't like having to use the subway and the bus. Furthermore, even though a car is a depreciating asset, nobody's telling you have to spend top dollar on a car. Nobody told me to go out and buy a Mercedes S-Class or BMW 7. Nobody told me that. I bought a Jeep that's reliable and it does everything through all the weather, and I'm happy with it. And it didn't hurt me before I paid it off. It really didn't hurt me. Second of all, a house, if you're taking out a mortgage, just because you take out a mortgage, there's a lot of rhetoric. Oh, you don't really own the house, the bank does. Yeah, there's a lot of rhetoric behind that. But guess what? When you take out a mortgage, there's a date certain that mortgage will be paid off. It's not going to last forever. As long as you don't keep refinancing or keep taking out more money or keep changing the terms, eventually that house will be paid off.
Or if you got to send your kids to college and you take out a home equity loan, and then you're a baby boomer in your 70s and you're like SMH or FML, like you're still paying this and you're on the verge of retirement. Like, unless you do that, like, if you are trying to pay off your mortgage and you're dedicated to it, you're committed, and you don't try to take out too many loans against your mortgage or your home equity, then hopefully you'll be all right.
Yeah, and my thing is, once that house is paid off, that is a wealth. That is wealth. And as long as you have children and you teach them how to maintain that house and how to simply get a job to pay the taxes and to maintain the house, that is intergenerational wealth. But guess what? Just saving up the cash money does not guarantee you later on that you'll easily be able to purchase a house cash, simply because you're chasing inflation. The more money you save up, the less your money is worth. Go ahead.
Yeah. The only thing I was going to say is, if you feel like there's no way you can put enough of a down payment now, then maybe you focus a little bit more on trying to invest your money so that your money is still growing. So it's not just sitting, rotting away in a bank account. But if you find some good investment opportunities, and I say that carefully because I feel like we're at market all-time high, super expensive market conditions right now. So I say this very specifically: if you find a good investment opportunity so that you can grow it at, even if it's at 7 to 10%, better than getting peanuts on the dollar in a bank account. And if you grow it, so let's say you're 21 years old and you're getting out of school, and obviously you don't have much money saved up because you're tackling student loans, it's okay to start putting your money away and saving it up and then investing some of that, like definitely have an emergency fund, but also invest some of your money to then grow. And then if you hit your 20% down payment goal, like, depending on where you live, this could be a substantial amount. If you need to get 20% down, like even if you buy like $100,000 house, 20% is still $20,000 that you got to save up before, you'll have better terms with your mortgage. So like, I totally agree with everything you're saying, John. And, for people, like do the best you can to try to put yourself in a good position so that you can achieve your big ticket financial goals that you have.
Well, and let me say this. Cash right now, I hate to say it because some people, investors, these big investment guys, they say cash is trash. The reality is, you have to decide how you want to set up your personal portfolio. There are some people, especially here in Manhattan, there are some people who will rent an apartment, Brooklyn, Manhattan, Queens, whatever, and they will put the majority of their money into the stock market. There are some people who have no car. They will take that money that they would have normally spent on a car, put it into the stock market. There are certain people who've decided that I want to do nothing but buy houses. They will buy multiple properties, rent out those properties, earn money over the time. They will pay off those mortgages, and then they will have 3 properties under their name that they can pass to their children to rent out or to live in tax-free, well, not tax-free, mortgage-free and rent-free. You're still going to pay the property tax. The government ain't letting you off on that one. So my thing is, there are a lot of debt shamers who say, and I was listening to Dave Ramsey. I listen to what these people say because this way I understand what people are hearing. They're like, oh, well, we don't work. Oh, well, how does he say? He said, oh, we don't worship at the FICO altar. We don't worship at the FICO altar around here. Yeah, well, guess what? Your credit score might make the difference between you getting a job and not getting a job. If you want to go into certain levels of work, they're checking your credit. If you want to rent an apartment, they may check your credit to make sure you're credit worthy. There are a lot of renters who got burned within the last 2 years, and they are checking people's credit and their backgrounds to make sure that these people are not credit or flight risks and are just going to leave and not pay. So having good credit, you have to have good credit. It's not even an option.
Yeah.
In an emergency, you may need an emergency medical procedure. They don't care if you got cancer, brain tumor, whatever. If you can't take out that loan for your cancer, brain tumor, whatever removal, because your credit is not there, well, then you're gonna have a grapefruit grown in your head. So my thing is, no, this is important. So and the sad thing is, there's so much contrary information because what we're trying to teach is discipline. There are ways to handle a credit card. There are ways to understand it where you can handle it, you can build it, you can make it as good as it'll be, and this way, when you need it, it'll be there for you. Credit is a tool. It's a tool. That's why we're about to get into rewards and points and whatnot. Credit is a tool. Dave Ramsey, Savings Minus Debt, people who speak absolute rhetoric about the credit system and whatnot, they're talking mostly about and chastising the people who have screwed up, who are deep in student loan debt, who failed. We are 2 people who have succeeded in the game, and we're trying to teach you the game. Go ahead, Michelle.
Right, and I want to say that, like, there's no need to feel ashamed about debt. Like, I've had some family members who have been in debt, and I totally understand how they got to that point, and they've also worked on getting out of debt. So, you can get out of a bad situation as long as you're trying to put a plan in place and trying to work toward paying off that debt. So it can be done. Like, you shouldn't feel any shame. No one should ever make you feel like you're a dummy for doing that. And sometimes, like, you got to check yourself and control yourself. Like, if you're addicted to buying Nike shoes, and you have to buy so many shoes that come out, the latest and greatest all the time, and you're racking up the credit card debt, like, you gotta try to control a little bit. Like, maybe you can't buy all the shoes if your credit utilization is at 95%, because you got to pick and choose what shoes you can really afford. So, like Like, not that we're trying to take away your happiness with the shoes, but you got to be realistic about how much of this can you really afford. But then better yet, you can make money and then kind of make it into a game of yourself. So let's say, like, and I know we'll get into rewards and stuff, but let's say you're trying to be smart about how you're using credit, and maybe there are certain credit cards that reward you for spending on certain types of purchases, and then you use the rewards that you get to put towards your favorite kinds of purchases, whether they're Nike shoes or other collectibles that people have. So, anything that you want to have, like, you got to reverse the way that you afford it. So, like, let's say it will take you a long time to gather up a bunch of points so that you can buy whatever $300 shoes you want, but you make it a game. Make it a game like, with my spending, I'm going to make sure I get 5% cash back, and then you can track that and have that go towards your $300 shoes, and then be able to reward yourself after you've hit that milestone. And not that you're just spending money for the sake of spending, so that you can then reward yourself. I mean, there should be sort of some limits, because if you always want to have your cake and always eat it too, I mean, that's not going to be good for your health, and it's not going to be good for your credit score probably, because if you're in just too much debt, if people still understand where I'm going with this cake analogy, like, you don't want to set yourself up to be in financial trouble just for things that, you'll take a look at them. I'm sure you'll admire the collectibles you have, but unless you're trying to like make money, if you're trying to make money from those shoes, like, and I've seen like on TV, people go to like shoe conferences. So if you're trying to make money, then great. Like, you're using arbitrage to try to make money off.
Arbitrage. That's the word. Arbitrage.
Yeah.
Not to cut you off. Not to cut you off. About the shoe thing astounds me, but I will say that, first of all, just in case you don't know what arbitrage means that you buy an asset from one market, you take it to another market, and you sell it at a markup, so you make some profit in that next market. Now, when it comes to shoes, here's the problem to me. Shoes, in and of themselves, some of them can be considered a store of wealth. Now, if you're using arbitrage, then that's fine. The problem is most people aren't. That's the problem. They're buying them, wearing them, and
and then they lose their value, right? So like you have to, kind of like think about the trade-off, like how much you're putting into some of these things. And if you can make money off of it, that's amazing. That's wonderful. Like those people who are, selling their first edition Pokemon cards, and, if you're making bank, like getting 250 grand on your first edition Charizard, then good for you. If you had that for all these years and now you can buy a house in Texas with that money, like, good job. But like, if you're a kid and playing with all these things, collectibles, and then you wear them out and they're no longer like, worth as much, then it's kind of like too bad. But yeah, I mean, it's a little bit of a long-winded, and I'm not trying to attack anybody out there for your collectibles. I'm just trying to encourage you to try to think about financially where you're going with some of this. Like, what is it all leading up to? Like, if it's just something that makes you happy, like, try to do it in such a way that you're not financially suffering as a result. That, like, you can't even, open up your credit card statement because you knew that you bought a little bit too much last month, and now you're like kind of kicking your feet, regretting, or kind of like not being willing to fully confront the truth of what you might have spent on. But like, with like some of, the doctrine that's out there, that some people are like, shaming you if you're too much in debt. Like, you got to use debt as a tool, like you said, John. And if you can use debt to your advantage and not to your disadvantage, you will come out on top. Like, you'll have an 800 plus credit score like John and I do. And I'm totally happy. And I don't have a lot of belongings, and I'm human like everybody else. So I have some belongings, but I realized like some years ago that I don't need so many materialistic things. Like, I don't need to have the nicest car. I don't need to have the best shoes or the best clothes. Like, and I actually mentioned this in my latest video, I would rather look poor but secretly be wealthy than look rich and be secretly poor, because I've seen plenty of people like growing up where they had the fancy BMW and Mercedes in a driveway, but then all of a sudden, like in a few months, like during the great financial crisis, I saw their house like being foreclosed on. So you can see the sort of discrepancy between like people who are trying to look rich but then really aren't, and then the people who, like people like Bill Gates, they look like a nerd and they look like, like and
Zuckerberg, Gates,
yeah, but
Warren.
like nothing against nerds. Like I like nerds, but like they look like people who are just normal, and yet like people like Bill Gates are obviously billionaires, but you don't have to look rich to be rich. And I think like if anything else, like from books like The Millionaire Next Door, you can learn about people who they live really modestly. They drive like a Toyota Prius, and they live in a 1,400 square foot house, and yet they're a millionaire being a janitor, and somehow they're pretty humble, but yet they're financially secure, and they live on modest food. Like they make their food at home, and they're not eating out all the time. And just for any millennials or Gen Z out there who like avocado toast, like you can buy your avocados at a farmer's market and good bread from a good grocery store and make your own avocado toast at home, and it's way cheaper than going out to brunch on Sundays all the time. So definitely there's so many ways that you can still enjoy the things that you enjoy, but do it in some extent of moderation, unless you've made it and you have plenty of income coming in that you can just afford whatever lavish lifestyle you want. But for a lot of us that have modest incomes, and we're just trying to do the right thing and try to set up our future descendants for a good financial future, there's so many things that you have in your power to do now, so that you are using debt to your advantage and not letting it control your life.
Speaking on what you were saying, there are people spending at Starbucks $9, $10, $20 a day eating at Starbucks. And you know who else is really good for that? Students. Because in many of the colleges, there are Starbucks, there are McDonald's. A lot of them will go to those places because they're social gathering spots, and they'll do that instead of just sticking to the school meal plan or whatever. I like Dunkin' Donuts, the drinks they make, coconut refreshers, matcha. I learned you watch how they actually make it and then compare that to maybe some videos on YouTube. You go out and buy the raw ingredients. You make it. I just bought a brand new blender. I got a Ninja something or rather from Walmart with them sharp blades, and I can make my own fruit smoothies. I can make that stuff myself, and it tastes pretty much the exact same. Now, as far and maybe you'll do a video about this eventually. What I was trying to talk about why debt shaming kind of doesn't make sense in this case. As time goes on, our cash is worth less.
Yeah.
Because of number one, the cost of inflation, and because saving your money in the bank. I looked at one of my bank accounts, $11,000. The interest on it was like $1. No, I don't even think it was $1. It was a little bit less than $1. It was like 90 cents. And I'm like, when I was a kid in the 80s, we're getting 10%. 10%. Now you're getting less than one. So my thing is, trying to save up cash and chasing a future property does not make sense. I need a house now. You see the place I'm in? I need a house now. I need a roof over my head now. Now, granted, if you have some other arrangement and you renting with the possibility of chasing to buy a house makes no sense, because over the time you're renting, you don't get any equity. And a lot of, like I've tried to tell my sister this, some people get really, really comfortable doing things one way, but in the long run, especially when it comes to building your own personal wealth, in a long run, home ownership, and they're starting to say it more and more when you watch these financial shows, is the best hedge that you have against inflation, because this country cannot make more land. Now, I will say this, China, they take sand and they dump it into the ocean and they're building land. We're not making any more land as far as I know. We can't make more land. And your property, the land that your house is on, in some cases, that can appreciate even if the house value doesn't appreciate. Let me send a shout out to Yaromir Yagar. He just sent us a $25 super chat. And apparently he loves Brembo brakes. So he must be a more part guy just like me. Okay? So what I'm saying is, chasing inflation makes no sense. The banks are not helping you. The government is not helping you. The best thing you can have is a property that you can live in so that when you're spending that money on that mortgage, it's going ultimately back to you. Now, granted, and when I get into this amortization schedule with this calculator, yeah, I'm going to show you. The bank is going to make their money off of you one way or another.
Mhm.
I buy a $300,000 house, the bank is going to make 100,000, maybe 125. Yes, go ahead.
Oh, sorry. I just wanted to jump in after you made your point. Like, did you still want to say a few things, or like,
No,
should I?
well, no. I was just going to basically end by saying that. Listen, the bank is going to make money off you one way or another. If it's not the bank, if you buy a car, the dealership's going to make their money off you one way or another. It's better to try to live within your means, buy what you need. If there are things that you really, really want, save up, buy those things you really, really, really want. And that's the thing. It's like just try to stay within your means.
Right.
Okay, go ahead.
And what I wanted to say was like the only kind of sort of exception to, I mean, you're still paying in fees and closing costs and whatnot, but if overall, like let's say inflation really is starting to be a lot higher than it's ever been since like the 70s in a while or 80s, like if it's really starting to heat up, like if you get a mortgage that's at 3%, but inflation is at 5%, like real inflation, and I know a lot of people have different ways of calculating inflation. So we don't have just like you can't just rely on CPI or PCE. Like there's all kinds of measures of inflation, but in general, like if real inflation is at 5% and you have a loan for 3%, you're basically getting paid an extra 2% in like indirectly by the value of your mortgage evaporating, since like inflation is much higher than your mortgage rate. So that's why there's probably been such a gold rush towards getting homes right now, because people are like, oh my God, I have like basically a free loan, so that inflation is wiping out the value of the interest and the debt payments on your mortgage. So in that case, if you can make your debt work for you, this is another example of why it's weird that you should be being shamed about debt, because if you can take advantage of inflation with low interest rate loans, you could be sometimes be paying paid to like take out a loan, which if you can make that be productive, like you can buy a house that you can pass on for intergenerational wealth, like that would be amazing. Or like if you know that you're making money by borrowing it, like some people, I don't necessarily recommend this, but some people are kind of using that as leverage because they'll borrow money and then they invest it, then they kind of like make money. And I've never done that, so don't take my word for it. Like I'm not encouraging people to go do this, but if you know what you're doing, and if you know how to use loans work for you and not against you, you know, you're like way ahead of the pack. Like you can probably work on Wall Street because you're so smart with using leverage in your favor. So like, you know, all the power to people who can do that. And like, and I like this question from someone who has a koala as their profile pic. That's so adorable.
But I'm going to let you address that question. Let me just say, guys, if you just came in, please like, share, and subscribe as usual. Again, for you guys, I want to thank you guys again who are sending super chats. These proceeds are going to help Michelle on her channel. I'm going to, just like last time, I'm going to cut her a super chat. I'm going to send it directly to her after I tally it all up. And you guys are helping her channel. And please subscribe to her channels. Please subscribe to mine if you're new. But like, share the stream, especially if you notice somebody whose credit sucks, like my aunt who doesn't pay her bills on time, and I'm trying to explain it to her. Listen, this is how you do it. If you know somebody who needs this type of information, between the two of our channels, we address most of these issues. Okay, so I'm going to let Michelle explain from the one and only. Go ahead.
All right. So difference between due date and statement date. So let's say,
Talk into your mic. You're a little. I think you're a little far from the mic. Just talk into your mic. You drowned out. Sorry.
oh, can you still hear it
You're,
okay?
you're better. You're better now. Yeah.
Okay, maybe I was leaning too close to it and then whatever. Like, so due date, like let's say your due date is August 8th and your statement date is usually some days before that. So your statement cycle, or the opposite, sorry. So your due date will be usually 28 days after your statement date. So your due date would have been August 5 if your statement ended on July 8th. So you have about, this is how I've calculated it, like around give or take 28 days. Like I don't know why they don't make it like 30 or 31 days, but I usually find, so like if your statement date ended August 3rd, you will probably have a due date of the 28 days after that. So it's either going to be around September 1 or so. So just think about that. You have about 28 days to be able to pay that balance in full if you're able to, and I highly encourage that because that's what I do every month is I always pay before the due date or exactly on the due date, but I recommend that you do it at least a few days before your due date because sometimes like depending on how linked your bank accounts are, like if you're using the same bank, like you have a Capital One credit card and you pay it from your Capital One checking account, it's like much more easy and it will like land pretty much within that instant second. But sometimes if you're using different banks, like using Capital One to pay a Bank of America credit card, maybe it'll take like a day or a little bit to kind of like register. So you always want to try to give yourself a few days before your due date to like pay the balance in full. So, oh, that's so nice of you guys to tell me I'm the real Robin Hood. Like, oh man, you don't want to get me started on what I think about the Robin Hood that just recently
Yeah.
IPO'd.
Yeah, well, everybody know. Well, and I will say this: Robinhood had a terrible IPO launch. However, I guess because of the redditors, they shot up to the $70 range, but then they fell down to the $55 range. Robinhood might end up bankrupt because the problem is they don't, just like Airbnb, Coinbase, they don't make money. They don't make profit. They'll never pay a dividend. The one thing I was going to mention before is like when you were talking about being a rich person that would prefer to act poor instead of a poor person acting rich. The one thing that always stuck with me about Warren Buffett was when I heard that he bought used Cadillacs. And I was like, wait a minute, this guy's got more money than God. And this guy is buying used Cadillacs. Like he bought a XTS, which was actually a car that I really liked. And before that, he had a Cadillac DeVille. And I don't know what he has now. I think he actually traded in for something new. And I was like, why is this guy buying used Cadillacs? It's like, regardless how much money they make off me, if you know, I want like, but that's what he does. And if I was him, I would have had a custom Bugatti built for me. But he liked used Cadillacs. I don't know. And I just found that so interesting, you know. And my mom is a Cadillac person. I was telling you that I'm trying to force her into the new electric car, the new Cadillac Lyric. I'm trying to force her into that. What were you going to say?
Well, yeah, because if you think about it, if you have a good handle on your money, you know what's a good way to put your money to work and to be able to grow for you so that it's not just kind of like losing more value. Because if Warren Buffett had bought a brand new Cadillac, he probably would realize like as soon as I drive it off the lot, it's instantly worth half what I paid for it. So why should I do that when I could buy a Cadillac that looks the same and is a year or two old? You know, because usually these car models are within 4-year cycles. So if you can buy a slightly older version of the same thing, like why not save like more than half? Like that's the thing that I did when I bought the one time I had a car loan was the car I bought was only 2 years old, but it was like half off the retail price for a brand new version, and it looked exactly the same. It just had more miles on it, and I was able to get a lot of miles out of that car, and it lasted a really long time. So I think that I made off like a bandit or like a Robin Hood by not having to pay so much for that car, and that's totally like you can win-win. Like I totally love pre-owned certified cars because the dealership will upgrade the parts on the car and you get like almost a lot of new things like new tires, new
Oh, you're talking about certified pre-owned.
Yeah. So like a lot of times you save way more money getting that and like it's almost as good. Like you just have to live with a little bit more miles on the car. And yeah, I talk about some of this in my recent video too about how if the car has like lived past like 1 or 2 years, usually it's not a lemon anymore by then because every now and then like 150,000 new cars each year or 1% might be lemons. So you know, you also take off that risk of like if you get a pre-owned certified car, the dealership is saying like this is a good car. We checked it out. It works. And then if something's wrong, you can always take it back to the dealership and be like, hey, look, you guys said that it had a clean bill of health, but yet there's this thing going on. Like, like you better fix it. And I think a lot of times, at least in my experience, they will fix it. They will like deal with, whatever it is, because, more than likely, if they've certified that it's in good shape, you're getting a pretty good deal and saving a lot of money instead of paying for a brand new version of that. And I'm curious what you think about how this might work with electric cars, just because of like battery usage and stuff. But that might be a conversation for another day of like how that might, work. And do we want to check out Devontae's question?
Yeah, before we move to Devontae's question, I will just say this. Electric cars have fewer parts than gasoline cars. The main issues with electric cars are always going to be the electric motors, the driver gauges and computers inside the cabin, and the main battery for the car, which is a battery pack that's made of individual cells, right? The way I see it, initially, it makes more sense to lease those cars because this way you can test it out and you can decide whether or not this is for you. A lot of people who've leased Teslas gave up on them because they said, you know what, this car doesn't fit my lifestyle. I don't feel like charging it. I don't feel like waiting for it to charge. I like to take road trips. Some people, it just doesn't fit their lifestyle. So there are some people who are like, you know what, take this back, swap a lease, blah, blah, blah. For me, to be able to drive back and forth into Manhattan and not have to pay money for gas, you don't actually see the savings until you've broken even. So down the road, I will see what happens. I'll see what they offer. I'll see what it costs. I'll see what the insurance is, and I'll make a financial decision later down the road. I just want it because I want the excitement of new technology. Not to mention it. I use cars on my channel, as a blog. So basically it helps me in getting money back in that I'm blogging about this and building a community of people interested in a certain car. So in the long run, it pays itself back. It's just like my iPhone. Yeah, it's a $1,700 phone, but I shoot all my videos on it. I earn money back from it. It pays for itself. So I guess the best way of saying that is almost every purchase you make, if you treat it like an investment, that helps to build up your discipline when it comes to investing. So yeah, you can address Devontae's comment right there.
Well,
we have one from Struggle. Go ahead.
I like this. I like this question because I have plenty of credit cards. If you saw the thumbnail of this video, you could see I was like holding a stack of cards that I've opened over the years, and like I think a lot of people are afraid maybe to have too many cards. Like they've maybe been shamed into believing like, cut up your credit cards or something. And maybe you should cut up your credit cards if you know you can't be responsible for it. So a lot of this requires you to look inside yourself and figure out what you can handle. And like I use right now about 4 or so credit cards on the regular, maybe 5. So I have about like 5 credit cards that I'm mainly using at the moment. And they all do kind of different things. Like some are better for cash back in certain categories, and some are better for travel reward miles, and some are better for getting discounts at a department store, whatever. So depending on what you're trying to achieve, like there's nothing wrong with opening a second credit card. Like I think it's a great idea. And I personally love taking advantage of opening bonuses. Like if a credit card is offering me like $200 for spending $500, I can do that easily. Like between charging my cell phone and internet bill and other everyday life expenses, like I can easily accomplish spending $500 in 3 months to get $200 back. Like that's a return rate of 40%, which is awesome. Like I want to take that deal up as much as I can, but of course I don't want to open up too many credit cards to get that kind of deal, because then you don't want to have too many inquiries either. So like, yeah, like if you can be responsible and if you don't already have, like maybe a couple of cards that you use, I think getting a second credit card is awesome. And then, maybe you have some friends who might want to give you a referral code, and then you get an extra bump of like a little bonus money and they get another bump. So if you have a friend who might want to give you a referral code, like take advantage of that. So you and your friend or your family can both make some money on new credit card opening bonuses. Like, I think those are amazing. And also sometimes if you add an authorized user, you can get like an extra certain amount of points, like 5,000 points, which might be like $50. So it's like, why not? If you can handle it. So, operative word there, if you can handle it, like that's what's important, because of course, if you might open a second credit card and you're just going to be irresponsible for it and you're never going to pay your balances on time, or if you don't think you can pay it in full, it might not be the best idea to set yourself up with another card that may or may not be working for you. So you always want to make sure that the credit card that you're using is making you money and that you're not making money for the bank that's offering it to you, because then that's not fun. Then there's no point in doing that to yourself if your credit score might go down or you might get in more debt. Like, that's just not a good time. So just try to see and weigh it with yourself what you're comfortable with and what you realistically can commit to.
Now, before I'm about to move on to rewards. Both I and Michelle have a small rewards presentation to show you. But let me just say this, Devontae, as far as the second credit card, obviously you're going to have to open more than one credit card in order to build up your credit availability. Just like I talked about, if you rewind the stream, you want to ultimately be able to have between $30,000 and $50,000 of available credit. One credit card is not going to give you that much. Now, if you have two or three and each one's worth $10,000 in credit, that will give you $30,000 worth of credit availability. If you have five and each one is worth 10, that will get you to the $50,000. You probably understand how it works. Individual cards might be able to give you between 10 and 15, but typically individual cards do not go as high as 20, because that would be just a risk. That would be like saying, you know what, if we're giving this person access to $20,000, usually you don't see credit cards like that unless you have a business credit card. Like if you have an Amex business card, the reason why they give you high credit limits is because you may have to pay an employee's salary using your credit card. You may have to pay for a brand new $10,000 printer, a $30,000 Macintosh computer. You might have to pay for a bunch of flights to get your people back and forth from one state to another. So if you have a business credit card, that will usually have a much higher limit. What I avoid is annual fees. I refuse to pay for the privilege of using a card. So what I show you right here, you probably already noticed if you follow me long enough, I use the Capital One Venture card. This is a screenshot from my account. Now, understand how miles work. Now, I like to travel. I do travel vlogs, right? The way this works is that as long as you purchase things on your card and you pay the balance off before the due date, you never make any payments of interest on your card. So it never costs you interest. It never costs you a finance charge. No, I won't say that. There are some things where they'll try to charge you a finance charge. So if you ever see something where they say, listen, if you use a card, we're going to charge you $2 or something like that, that's a finance charge. I avoid finance charges. I do not pay annual fees. I do not pay interest because I pay off my credit card every other night. I don't wait till the bill comes. I don't wait till the end of the month. The people who don't do that are the ones who are subsidizing my rewards. Understand that. I'm disciplined. They aren't. The credit card companies subsidize your rewards points by charging the other people fees who are not paying on time. Now, I should point out in 2008, when we had the financial crisis, I used to get rewards points on my debit card. But the banks realized that because of the credit crisis, a lot of people had switched from credit to debit. So once the banks realized, wait a minute, we're giving these people rewards points and we're not making any money off of it, they took away rewards points from the debit cards. So I was like, oh, okay, so you're forcing me to start using a credit card again. So I vowed to myself, okay, you know what I'm going to do? I'm going to use your credit card I'm going to pay off the bill every single night, and you're never going to get interest off of me. So I avoid annual fees. If you see a card that has annual fees, chances are you could do better by going for a card that has less rewards but has no annual fee. Because you think about it, 2 years of COVID, you couldn't even really travel. So that means that if you were paying for an American Express or a United Airlines or any, I had considered the Emirates credit card, and I was like, wait a minute, I don't fly to Dubai that many times where I need something like this. If I was the sheikh and I'm flying back and forth, oh yeah, I'd have it. But it's better to go for no annual fee, pay on time, do not pay interest. It's just so better. So this is my card. I have right now 94,000 miles. I buy everything on my card. I buy gas where they don't charge extra for credit card use. I buy my groceries. I buy any electronic equipment I need, especially for my channel. I'm going to inquire about ways that it's possible for me to pay for even bigger things that I can pay for on my card so I get even more points. The key is I never spend more money than I have in cash. As soon as I use the credit card, I pay it right back in cash. So this 94,000 miles, by the end of this year, it will be easily over 100,000 miles. When you do the translation into booking a ticket, that comes out to about $1,000. So before I show Michelle, I am considering, and some of y'all follow me, so some of you guys know, I am considering going to Maldives. And when I go here, oh, did I share that? Oh, yes, I did. Okay.
Yeah.
When I go here, I plan on definitely flying business class. So I already know the ticket's going to be about $3,000 because round trip, I intend to be sipping wine before the plane even takes off. I love the service that you get, the carry-on bags and whatnot. I made a couple of videos of business class on some airlines already. I wanted to do Emirates, but I don't know if the A380 is still going to exist in a year or two because they're trying to get rid of it. But I want to do it as vacation, and I'm going to pay for my resort using the credit card miles. So I'm going to spend all of the miles and pay for the resort. What you want to avoid is credit cards that have limitations on the rewards. Some cards will delete your rewards if you don't use them, or I should say your frequent flyer points. Some cards, especially airline cards, I avoid because if you don't use those points within a certain amount of time, they can get rid of them. They can delete them. I've lost points on Emirates credit, on Emirates frequent flyer travel system. I've lost points because I didn't keep traveling. For the last 2 years, I couldn't go anywhere because of COVID. A lot of airlines had to address this by saying, okay, what we'll do is we'll pause your points. I use credit card, Capital One, and I use Apple Card. They have no expiration. They have no annual fee. And for the most part, as long as you pay on time, you pay no interest. So everything I'm financing is stuff that I normally would be buying anyway. And then I'm paying it off at the end of the day. I pay no interest. Let me pull yours up, Michelle. Let me pull yours up. Let's see. Somebody, Snuggles, said, I would like you to have this conversation with Savings Minus Debt. It would be very interesting. To tell you the truth, the problem is I already understand the rhetoric. I don't deal in rhetoric and I don't deal in debt shaming because you have to understand, I work in finances. I have a lot of clients. It doesn't look good for me to sit there and say, oh, yeah, well, you messed up. You should have been smarter. You're a credit slave. You're a slave to the system. It doesn't really look good on me to say that kind of stuff to a customer or a client. It doesn't look good. So I don't deal in rhetoric like that. If I'm going to teach somebody, I'm going to teach them how to do better. I'm not going to shame them. I'm not going to speak to them in rhetoric. I'm not going to do it. So that listen, it may happen, it may not. Chances are it won't. I don't know. But that's the bottom line. It's like if we're teaching you about credit card discipline and credit card calculation. I don't do, oh, well, I don't worship at the altar of the FICO score like Dave Ramsey. I don't do that. I just don't do that. And that he's so rich, he has enough cash to buy pretty much whatever he wants. And that was after he went into a bankruptcy, mind you that. I never declared bankruptcy. I never had to declare bankruptcy. So what I'm just saying is, if you're going to teach people, teach them. Don't shame them. Shaming them doesn't help. It doesn't work. It doesn't really work. And when you're dealing with clients like I've got, oh, it doesn't work at all. It really doesn't. All right, Michelle, go right on ahead, and you can. Let me see if I can just make this a little bigger, but you can explain your words here.
With if savings minus debt is referring to Dave Ramsey, I don't know if
No. Savings minus debt is a guy who's on our Manosphere. That's it's like a niche group. I think it's about less than 10,000 people, and his idea of giving advice for credit and mortgage: stay away from credit, stay away from mortgages, and he talks in absolute rhetoric, but because he doesn't own a house, he doesn't understand certain aspects of owning a house. For example, he thinks equity for a house, he thinks it's your mortgage balance minus, no, I'm sorry, he thinks it's the value of the house. No, not the value of the house. I forget what he says. He thinks it's your he basically is talking about your net income or your debt to income, right? But in reality, your equity is the value of your house on the market minus what you owe. So if you have a house that has suddenly appreciated in value to $500,000, but you owe $100,000, your equity is $400,000. However, until you pay off that $100,000, he calls you a slave.
Oh.
So I can't deal with the rhetoric because it's not productive. It's just not productive.
I mean, like, honestly, nobody should be made to feel like they're less than that they are and that they're worth less. Like, life is hard enough as it is. And if we can learn anything from somewhat Olympians have gone through recently, we all have issues in life. Everybody has problems. Everybody is going and fighting their own battle. And the last thing that we need is anyone putting us down and making us feel like we're, less than. So, like, it's okay. We all make mistakes. Like, I'm not perfect. I've made plenty of mistakes and I've lost money and I'm still learning. And Warren Buffett has made mistakes. And the important thing is that you're able to admit your mistakes to yourself and that you're able to grow and learn from it and try to do the right thing, even if it's just a gradual step in the right direction. And even like someone like the CEO of Markel, a really well-known corporation that does really well financially, Tom Gaynor, he has always done moves towards the right step. And if you look at him, he's the type of guy who drives a Toyota Prius, but he's a multimillionaire and a very popular leader and CEO of a company. Like, that guy is someone that we could all learn from. And he's all about making small steps in the right direction. Like, I'm pretty sure that he's probably had some struggles in the past that he tries to do better by exercising regularly and trying to have a good lifestyle. And so there's lots of positive lessons we can learn from other people that we have to just be kind to ourselves. We have to love ourselves. We have to forgive the mistakes that we might have made, and then just keep moving forward to, like, look to the future and ask yourself, how can I do better? So try to surround yourself by positive voices that encourage positive thinking, because that will really help you get to your next level. Like, when people are putting you down, when they're making you feel guilty or they're shaming you about it, like, you don't want to kind of take in that negative energy, because it's just like this vicious cycle of negativity, and that doesn't help you or anyone in the end. Like, I really believe that positive thinking will get you a lot farther. And so, yeah, like, I mean, if it helps you to listen to someone who tries to give you tough love, like, maybe if you're the kind of person who needs a little bit of that tough love to get, like, the kick in the pants to get going, then it's okay. But, like, just know that there are also more positive ways that, you don't have to be made to feel like you are a dum-dum for some of the actions in the past. Like, if anything, like, Dave Ramsey should be the first to say, like, like, I messed up, and and it's not great, but like you can learn from me, and here's how I want to help build you up. And maybe he does do some of that. Like, I'm not trying to be unfair to him because I'm sure a lot of people admire him too. But just like, try to take it in context. Try to look at your own life situation. Take a step back from a lot of talking heads, because people are also just speaking in generalities. Like, I don't live in your shoes, so I'm trying to walk in your shoes. I'm trying to imagine what it could be like, but like I want to give you the freedom and space that you got to make your own financial decisions, and you will learn one way or another, come hell or high water. You will figure out what makes sense for you and what's right for you. And I think a lot of people will be on their way if you just forgive yourself and try to build one step at a time in the right direction.
Yeah, and as you can see, Michelle, especially on her channel, she's much, much more positive than some of these recent debt shamers. And I'll even say this, Susie Orman, I used to listen to her a couple of times. She was more positive than you get with Dave Ramsey and even people like Savings Minus Debt. And the thing that you need to understand, wealthy people, or I should say, no, not wealthy people, let me say rich people or people who understand this system, a lot of them have nothing but contempt for poor people. And the reason why is because when they see the government doing things to try to help them, even though they ultimately see the bigger picture and they feel that it's coming out of their pockets. So you have to understand, it's just like when I talk about interest. When I was younger, interest rates was 10%. Here's the problem though. When you have high interest rates, it reduces the amount of credit that people have access to. If people have less access to credit, that means that wealthier people always have access to expensive things. Poor people have no access to it. So the thing about it is, in the high interest system, you actually have real economic growth because you never have false economic growth and high inflation. Because when you actually make people accountable for the money that they're borrowing, instead of allowing people, expanding the money supply and allowing people access to the money, it makes it so that there's less money out there, less credit access, less money going around. If we had a high interest system, most people wouldn't be able to have an iPhone. Most people wouldn't be able to have a luxury car. But by expanding the money supply, what they've done is they've put these things in the hands of everybody. But the really wealthy, the rich people on top, when they see that you're driving the same Mercedes that they are, they don't want to see that, because they're like, oh, well, what did you do to get it? You can't afford that. And then they'd say, oh, well, they're taking it out of my pocket, because when they lower the interest rates and make it easier for these people to afford it, that hurts me because my savings is now worth less. So now I have no choice but to go to the stock market to try to capture dividends because I have no other way to build my money. I don't want to go into gold. I don't want to go into silver. I don't want to risk money on crypto. So the more you understand of this system, you understand the mentality of these people. I listen to Dave Ramsey every now and then. I listen to the Savings Minus Debt show. I listen to the debt shamers in general. I listen to the gurus. And I don't like what I'm hearing. And I'll listen to them even though I don't like what I'm hearing, because there's always some truth in it. There's always truth in it, but that's behind all that rhetoric. And I listen so I can learn, but I try not to use that rhetoric on people who I want to help.
Yeah. Well, and honestly, that's between them and whatever higher power they believe in. Like, if I'm so lucky and fortunate to become a truly wealthy person someday, I want to try to give back and help people as much as I can, to be able to give back to society. Like, that's what I'm all about. So, if you find the really good people, and I think that some people like Warren Buffett are really good people, like he isn't like jealous that someone is buying a brand new Cadillac and he's buying a used Cadillac. Like, he doesn't care. But you can see that someone like Warren Buffett is such a positive person because he is giving back to society, and he's doing it in so many ways. Like, I know he's given a lot of his wealth through the Bill and Melinda Gates Foundation, but I know in general, like, he's planning to give away most of his wealth. So that's, like, I think should be the ultimate goal of anyone who's planning to be rich, is to like try to help other people, because you can't take it with you when you die. Like, you're just gonna be in the ground like everybody else. And honestly, like, I think that's the best thing that we could do, is if we're in such a financially fortunate place, that we should help people. Like that's what I'm all about. I want to give back since I feel fortunate enough, like I feel financially secure enough, even though I'm not yet able to retire from my job. But like someday I plan to. And you know what I'm going to do? I just want to keep helping people because I know, like, I feel like I've figured out the system enough that if I can help more people figure out the system, that they will also be on their way to at least being able to financially thrive. And, you know, hopefully all of us reach fire someday and the ability to be financially independent and retire early. But, you know, as much as we can learn, like everybody who's on this channel, I give you so much props and kudos because you're doing the right thing to try to listen to people who want to build you up, who want to say, you can do this. You can have, you know, credit cards and have a great FICO score. And you know what? Like there's still some ways to go there. Like I know that credit access is not always as equitable yet. Like there is a lot of people, especially minorities, who aren't able to yet, you know, get access to credit, and it's super important so that we reduce income inequality and improve the lives of many minority people. Like so, it's important to try to get in the game of trying to have credit cards so you build up your score, and whether you ever get a loan or not, like for factors like you mentioned earlier, John, where you know you could be checked if you're trying to rent somewhere, or your job might check you if you are reliable in your credit payments. Like you may not always realize it, but it can make a difference if you have a credit history in just life in general. And this is sort of what's also separated people from being able to enjoy certain perks and stuff. Like I feel I feel like it's almost a game. I feel like it's like too good to be true that I can spend money at Trader Joe's like grocery shopping and get 9% back. So I'm getting like on $10 of groceries, I'm getting like almost $1 back, which is like I'm like, wow, like I just got this, you know, like this little grocery thing basically for free by being able to take advantage of cash back, knowing that I'm paying off my balances in full every month and I'm always on time. And I agree with your point earlier of trying to have as little fees with credit cards. Like I only have one credit card that I'm willing to pay the annual fee for. And otherwise, like all of my other credit cards are zero fees. So as much as possible, try not to have to pay any fees on credit cards if you don't have to. Like it's just unnecessary if you know better. Like if you can be disciplined, like John was saying, and if you can pay your credit cards on time, you can win at this credit card game. Like there's nothing stopping you from not having to have fees. Like I feel like people have been sort of like conned sometimes into believing that they have to have interest payments and have to have fees, but like you don't. If you know how to work the system and you know and understand what due dates are and you know what are the rules that you have to play by in order to excel in this game, like it's all about like knowing that. And that's why some of the rich, they've excelled because they know the rules of the game and they make it work in their favor. So yeah, that's like, you know, one thing to try. Oh, that's so nice of you, Craig. Thank you so much for your kind comment, by the way, of trying to do a regular stream. Maybe we should, because I feel like I think it's great talking about these kinds of subjects, and I really want to help more people. Like, and I think, John, you also want to help people a lot. So, you know, if you think between what John and I are saying, if it makes sense to you, you know, please definitely like our channels and subscribe and follow me on Instagram. And you can write to me, I'll write to you back. Like, you know, I greatly appreciate trying to just help build each other up and try to learn from some of the best investors and the people who have mastered personal finance. Like, you know, Mr. Money Mustache also puts out pretty awesome articles about like if you're trying to retire early, what it would take, how much you will have need to save and invest it, and how much your investments need to grow at in order to kind of afford your lifestyle. So like, you know, try to find these resources if you really want this for yourself. Like, so, you know, you could choose to stay ignorant and keep doing things that like you've done in the past and see if that's been working out for you. But maybe there will be something that you'll push yourself to like explore these new avenues of a different way that your life could be. And, you know, I think that your life will be better.
Roscoe says, I'd have been here sooner if you told me Michelle would be back. What are your thoughts, both of you, on the Amazon Prime Visa Rewards card?
Ooh, oh, great question. I love this. Oh, okay, wait. Can we get to Roscoe's question in a second, because then maybe you can
Okay.
open a browser, but let me finish answering or telling you about this, because I know you've had this United example up on the screen for a while. So
Oh, okay. All right.
we'll get to you, Roscoe. Roscoe, I will not forget your question, but so I don't know if people can make out what's on this screenshot a little bit. I don't know if you want to zoom in just a tiny bit, but
I'm gonna probably. Oh, I don't know why I'm doing that. Hold on. I don't think I can expand this screen anymore because
that's
of the
okay.
aspect ratio, but I think they could see it.
Okay. All right. So if people see this example, let's say you're flying from New York City to LA, and like this United flight, if you redeem reward miles like the United Mileage Plus and you want to use your air miles, that will cost you 23,600 miles. And then you pay like a little fee, like $5.60, which I kind of like don't pay that much attention to because it's pretty low. Like if they make that higher, like $50, that might make a difference, but usually they seem to keep these low. So if you look at this, I looked up both the award miles cost and the price cost for this round trip ticket. So you want to check what's the value if you're collecting travel reward miles and compare it to what it could cost you. So this flight, if you buy like the economy or the next like other economy, like I know there's basic economy where you can't bring on like a carry-on or whatever, but if you have the Mileage Plus credit card, you automatically have a carry-on and a checked first baggage. So it's not a big deal if you go for the basic economy if you have the credit card that goes with United. But if you don't, like let's say you pay normally for this ticket of $555. So let's say you're going for that first, and if you divide that into the equivalent of if you collected this amount of air miles of 23,600 miles, you're getting 2.35 cents per mile. And I think that that's a pretty good value because if you think about cash back, like a lot of credit cards might give you anywhere between 1 to 2% cash back, like on average, probably 1.5% cash back. So to me, I think this is good value because on my everyday spending, like let's say I went to a hotel and that gives me back actually double reward miles. So I'm getting like even a better benefit. But even if I didn't, every mile that I'm getting from there, if I can redeem that towards like a flight or other kinds of travel through, like if you had like Chase Sapphire, let's say, if you can get at least between 1 to 2% or better, like 1.5 to 2 cents per mile, and that's equivalent in the way I'm using this terminology to 1.5 to 2%, that's like pretty good. That's pretty like the standard amount I would expect. Like if you get anything less, like so if this was only a $200 or $300 flight for redeeming it for this amount of miles or 25,000 miles, which is where it usually is, then that wouldn't be as good. That would not be like maybe as worth it. So I would rather pay for the flight $200 or $300 than paying it through my air miles. So I'd rather save my air miles, and I actually like collecting as much air miles as I can. And if you watch one of my recent videos of how to make money or fly for free with credit cards, you can actually learn how I bank a lot of credit, a lot of air miles. So I like having at least 80,000 to over 100,000 air miles just in case there comes a flight. Like maybe at some point I want to fly to Europe or to the Asia South Pacific and or to South America, and I want to be able to redeem points. It helps if you have a big chunk, like at least 60 to 75,000 miles, so that I can redeem it for free for a full round trip ticket, and then that ends up saving me maybe like $1,000. Or like I know flights to Europe are pretty cheap nowadays. Like it's almost just as expensive to fly to Europe as it is to fly to California from the East Coast. So like I save if I can get more bang for my buck. So maybe it's not as worth it to pay 60,000 miles for, let's say, an $800 ticket to Europe when I could be spending so much less on miles for a domestic flight that costs almost as much as a trip to Europe, but I can get a better like cents to miles ratio. So if this makes sense to you, I hope share your thoughts and feedback. Let me know what you think about this example, and if you have other examples that you're wondering about, feel free to message me about like, is this a good flight and should I redeem miles for it or should I just spend my hard cash on this flight. Like, let me know what you think. Like, I'm always happy to help give my opinion if I think that it's a good value or not. But like in general, I'm trying to give you a little bit of a framework to think about how you are able to redeem your miles to, whether it's flights or hotels or whatever you're redeeming it towards. You want to try to get as much value out of it as possible.
I looked up, so I could pull it up. I looked up the Visa Rewards card. Let me just pull up the screen. Right here. Okay, so this is the Amazon, to answer Roscoe's question. This is the Amazon Prime Visa Rewards card. So basically, this is what you're ultimately looking at right here. So they say that the welcome bonus for the Amazon Rewards Visa is $50. The Amazon Prime Rewards Visa has a welcome bonus of $100. Now, the first one, the blue one, Visa card gives you 3% back. But in order to get the 5% back, you have to have the Prime exclusive membership, right?
Okay.
Now, 2% back on rewards at restaurants, gas stations, drugstores. You get 2% back. The next one is also 2% back. Both of them are 1% back on all other purchases, anything else that's not within the restaurants, gas stations, drugstores. There's no annual card fee on either. No foreign transaction fees, which is also good if you travel a lot. Bonus rewards at Amazon, you only get on the secondary card. You only get on the black card. That's the Visa Rewards Prime card. Now, here's the thing. In order to qualify for that second card, you have to have the Amazon Prime membership. As far as I know, I am not a membership. I don't have membership in Amazon Prime. Now, I did a little further digging. They say the Amazon Prime Rewards Visa offers strong 5% cash back on Amazon purchases and Whole Foods purchases. I've shopped at Whole Foods like once. I didn't like it. I don't shop there. I shop at like Uncle Giuseppe's, Walmart, Costco, and Stu Leonard's. With no limit to how much cash back you can earn. This earning rate makes the Amazon Prime Rewards Visa card the best credit card on the market for an Amazon purchase. In addition to the strong cashback rate, rewards are simple to redeem. So as far as how good this card is, let me just say this. Just like the Apple Card and just like many other cards that are linked to specific businesses or specific memberships, what you need to understand is that what they're trying to do is they're trying to pull you into their ecosystem. Once you get into their ecosystem, it's going to be really hard to get out. So if you are the type of person who purchases from Amazon Prime regularly, I am not that person. I purchase from eBay. I do eBay because I like their user interface. It's easy to bid on stuff. It's easy to watch the auctions. I like it. I just like their interface a lot better. Amazon, I've only purchased maybe a handful of things from them, and that's over a long period of time. The last thing I think I got was I got a vaccine passport holder. So, yeah, because the problem is when I go overseas, they're going to be demanding to see my passport, my vaccine.
You know what's funny? You say that. I've heard that people have been faking vaccination cards.
I'm waiting to find one, but no. Yeah, so basically you have this around your neck, and you have this passport cover for your passport, and this was a Tagari. There's other ones. But this is so that you can easily, when they step up to you and they say, "Oh, I need to see your papers. I need to see your papers." Well, that's what you have to pull out. So a lot of people are basically doing the connection between vaccine passports and 1940s Germany.
Yeah.
And the bottom line is, if you're a person who travels, you don't have a choice. There's no First Amendment. There's no HIPAA laws.
Until we get some apps, and then you can just have this stuff on your phone. But until there's the worldwide app for something like that, like TSA pre-check or the global pre-entry, whatever, those equivalent might be for that status, then at some point. So, John, do you mind if I try to tackle
Sure.
what I hear? So,
sure.
Okay, so I did the math really quick. I got a little handy dandy calculator and found that you got to be able to spend $2,400 a year to break even, getting 5% cash back on your Amazon or Whole Foods purchases. So if you can spend $200 a month, you'll break even on what is your Amazon Prime membership, assuming it's still around $120 a year, like give or take. Like let me know if it's more than that now, but I don't have Amazon Prime membership, but I've heard other people have it. So the number that I'm remembering is $120. So please feel free to confirm that if you have it or you know what it is. So knowing that you have to spend that to afford your Amazon Prime membership to get the 5% cash back, is it worth it to you? And of course, we all like $100. Like it's nice to have money, but you also have to check. There's no fees with this card, right? For either the blue or the silver or gray one.
If you're being forced to spend $2,500 a year, you've already paid the fees.
Well, yeah, but what I'm saying is like, does having this like the charcoal color card, it doesn't have any annual fees, right, by itself?
No, by itself, there's no fees, but you
Okay.
have to
But
you
so
have to be a
basically,
member.
yeah, so basically your annual fee is the Amazon Prime membership. So
Right.
to make it worth it, you gotta be able to spend that $2,400 a year minimum just to break even. So if you're a big spender at Whole Foods and Amazon, it could be worth it. If you're spending 5 grand and then the difference after you break even, you get that extra 5% cash back. If that works for you, then great. It might be a good deal. So, that was a I hope that helps anyone who's thinking
Yeah,
about.
because I knew that there was some kind of membership fee for Amazon Prime, but because I've never used it like that, I never knew about that. So, yeah, you broke it down beautifully right there. Because my thing is basically they're treating this like it's a black card, where because what it was, American Express started that with the Centurion, and they're like, yeah, you have to spend $250,000 a year and you have to do that every single year. So if you're a business owner, yeah, that makes sense because now you can pay everybody's salary and this, that, and other. The problem is you got to make sure you're profitable just so you can pay off that damn card. But yes, thank you very much for that because I knew there was going to be some kind of membership fee with that Prime thing, but I stay away from membership fees. Now they talk about foreign transactions and stuff. As far as I know, my transactions using my regular bank cards don't have foreign transactions, so that's not even that big of a deal. So, and when I go to foreign countries, I buy everything off my credit card. So the one thing you are noticing is the physical card is an option. It's just like with Apple Card. Most of this stuff that they're doing now, they want it to be digital. They want it to be on your phone. They want it to be on your watch. And they want you to just be able to touch your phone and that pays whatever it is, right?
That's a
The
little dangerous.
physical, I'm sorry.
That's dangerous.
Well, near field transact, I'll tell you like this. I use my watch, I use my phone for Apple Card, and I use my Capital One on it. I've never had a problem with it. The computers that they have watching your spending can recognize almost instantaneously if there's abnormal behavior. Like if they see that you're spending money in Paris and they're like, wait a minute, there's no way you're in Paris because they can track you. They can watch. They be like, oh, okay, Michelle, you purchased a ticket to Los Angeles, so we expect you to be in Los Angeles. You went to Europe, we expect you to be in Europe.
Yeah.
If they don't see a pattern of behavior and use, they know right away something's wrong.
Well,
So I haven't had that problem. Go ahead.
well, yeah, like I'm not as worried about like fraud transactions. What I'm more worried about is the behavioral, like self-control part of things being on your phone. Because like I don't know if anyone's heard of this. Like if you're a parent with kids and your kids love playing Roblox or something,
Yeah.
like you'd be surprised, but like even Wall Street Journal reported on this how kids just put their parents' credit cards and then were like, oh my God, my kids were buying all these like little whatever trinkets in that Roblox realm. And then all of a sudden they're racking up hundreds of dollars of costs that were just for the joy and entertainment of their children. And if we think about why this could be a little bit dangerous, is from the behavioral standpoint of, so much on our phones is gamified through apps. Like anybody who's ever experienced Robinhood and their little confetti going down if you make a purchase, like they do that so that you feel encouraged to go buy more, like so that you're like yeah, like I got some confetti and I'm gonna, this is like a positive feedback loop. Let me go buy some more stocks or play in options trading, which, be careful if you're doing that. Like some of these things are kind of like on purpose to make it seem easier to do. And it's no wonder that it's so seamless. Like you just swipe and then it's like boom, money went like flying, like so quickly. So why I say that some of these online cards could be a little bit dangerous is if you're not kind of keeping track of where your money is being spent on. Like it could be so easy to just tap on your watch, and this is why I'm glad I don't have a digital watch. It's just this automatic swatch that's from 1993, and it doesn't do anything fancy. It's just a watch. Like so, it could be so easy to just swipe and be like, yes, I will pay for whatever. And I don't know, like I like having that sort of guardrail of a physical card, or like having things that aren't so interconnected so that I'm not tempted to overspend. Because I give a lot of props to people who have that sense of self-control and that would not give in to a lot of like easy digital payments. Like this is why I haven't added any of my credit cards to like Apple Pay on my iPhone. Like I don't even want to be tempted to like overspend even just a little bit by making it so digitally easy for me to spend.
Well, yeah, I hear what you're saying. I'm kind of just the opposite. My thing is, I'm so attracted to the technology and the convenience that I'm willing to give these things a try. And from a standpoint of I'm explaining how it works to people, trying it myself, using it myself, that allows me to have the authority to be able to speak on it. And I understand what you're, because the one thing people need to understand, there are psychologists who are behind most of these companies, and they are constantly going into marketing and they're trying to figure out what sounds better in order to get you into these products. And these people gamify and they make all of these things extremely appealing to the point where they're trying to suck you in. And if you don't fully understand it, you just don't fully understand it. My hedge against the overspending possibility is still the same. I pay off every bill every night, and I never spend more money than I normally would because I know what I have, what my normal budget is. So there's different ways to handle it. So I got this guy, the Leon Sin, and he asked, Salute, what is a good credit card for beginners? So the Leon Sin, let me ask you this question. What bank are you with? Who do you have a checking account with? Who do you have a savings account with? The best way to focus on starting with a decent credit card is basically to get it from your bank. Avoid annual fees, preferably if you want to use a card that the way I see it is if you know that you're going to be buying a certain product or a certain product from a certain store over and over and over, that's when it makes sense to probably have a credit card. So if you're a construction guy and you work in construction and you need Home Depot supplies all the time, then it makes sense to have a Home Depot card. If you need Lowe's, then it makes sense to have a Lowe's card. The bottom line is no annual fee, pay off the balance immediately as soon as you finish spending. And as long as you stick to those two things, it doesn't matter what you're getting. But the point is, you're focusing on what your needs are. That's the point. It's a tool for your needs. Go ahead, Michelle.
Oh, and so I wanted to say this, like, I don't know if anyone ever checks out NerdWallet or Bankrate, but I love checking websites like those to see what are some of the credit card options, or even there's the Points Guy website. Like none of this is sponsored, so it's just from personal experience of trying to shop around for different kinds of cards. And so you can check out what kinds of rewards you might like. Like in addition, I agree with everything you said, John. Like sometimes it just is practical to link a credit card with your bank that you're at. So let's say you get the Capital One Quicksilver rewards, like, and you have a Capital One checking account, like that's perfect because you will see both accounts in the same window, and then you can easily pay your Quicksilver from your Capital One checking account, and it's like super easy, like it's so convenient. And if you redeem cash back, you can put it right back into your checking account if you want, or your savings account or money market account, whatever you want. Like it's kind of nice if it's all in one place and you can do one-stop shopping. However, if you're like me and you didn't think about any of this when I was 18 and I was so excited to open up my credit card, I'll tell you the first one I opened up, which was an American Express Blue Cash card, just because it had no fees, and I was like, okay, let me get an Amex. But what I realized is, like, interestingly, a lot of merchants don't really take Amex and they don't really take Discover that much. Like, some do, but for the overwhelming majority of my everyday purchases, it's way easier if I use a Visa or a MasterCard. So you also have to think about the practicality of what merchants you tend to shop at and if they accept some of these other cards. Like, I just went to NerdWallet just to see what they said for some of the good beginner ones, and I was sort of surprised that they sort of recommend a bunch of Discover cards and then point you to an Amex, and I'm like, these two are like ones that a lot of merchants aren't really accepting as much. So I'm like, I feel a little bit hard pressed to really feel like, really, are these really good beginner cards? Because in my experience, like, it was frustrating whenever there was a merchant that didn't accept Amex, so I had to like bust out a Visa or MasterCard. So, like, you got to think about that too, of if you sign up with some of these credit cards, and I've never owned a Discover card. So, like, to me, I feel like Discover is like maybe number 4 if you look at like an order of preference of like where I tend to shop. Like, most of the time I'm good with Visa. Like, I go to Costco a good bit and they only accept Visa. They used to accept Amex, but now it's only Visa. So Visa is probably like my best merchant, usage, followed by MasterCard, followed by Amex, followed by Discover. So if you take a look at where you tend to shop, would they accept a Discover card if you want to use it there? And if not, that might be a sign that maybe that's not the best card that you want to get as a beginner. Maybe you want to try to get a Visa or MasterCard, and you might have a better chance of your everyday purchases, that you can actually use that card and pay for them. So that's what I would suggest, is like a combination of what John and I said.
And let me just add to it. American Express, Discover, Visa, MasterCard, all of those are basically different transfer systems between banks. Now, as Michelle points out, a lot of companies here have disavowed, they don't want American Express. I believe it's because the transfer fees are so high. American Express charges them so much money that for them it's not worth it. Visa and MasterCard tend to be a lot lower. That's why those are pretty much accepted worldwide wherever you go. In fact, Visa and MasterCard, I actually bought stock in Visa and MasterCard, and it's been nothing but up. And it also has dividends. Both of them pay dividends. So I used to have Discover, but for the most part, I got rid of it. I still have American Express, but I barely ever use it. Now, when you say, again, what's good for a beginner, my thing is focus. As first of all, you have to develop a discipline for using it. That's number one. My recommendation is a Visa or MasterCard that has no annual fee. I would also recommend, if you're an Apple product user and you regularly use Apple products, you can apply for the Apple card, which is, again, a Goldman Sachs MasterCard. So if you do get qualified for it, that gives you a MasterCard from Goldman Sachs. Bottom line is, no matter what bank you get a card from, you have to still treat it the same way. You need to never spend more money than you can pay back, and you need to pay that money back immediately. Let me show you in my on my phone, my Apple Wallet, because I actually use this thing just like this. So let me show you my Apple Wallet here. That's my Apple Wallet. And as you can see, I do my digital transfers with Venture, with Capital One. I did add Robinhood, but I've never had to use that card. The Apple card, as you can see, right, I think I spent $20 on something, and the payment's due August 31st, but I'm going to pay that as soon as my car warranty comes on. And it's just $20, so it's not a big deal. One thing I do like about the Apple card, though, is for beginners, it gives you a breakdown of your spending. So it shows you exactly what you've been spending on. And I really, really like that. So by showing you a good breakdown and also by allowing you can pay early, as you can see, and it allows you to determine how much you want to pay by sliding the slider. So if I want to pay this right now, I can do 2058, and I say pay now, and then it looks at me and it asks you, is that really you? And then I just double tap it, and boom, it's ready to pay, and that's it. And that's it. And it just says payment received, and boom, now I have zero. So as you can see, $11,000 available again, and that's just that. And they have like breakdown charts where they explain to you where they're giving you discounts. Like they explain to you Panera Bread. I don't eat at Panera Bread. I don't think I've ever eaten there, and I have no intention really of eating there. They explain to you that if you go to certain gas stations, Exxon, you get 3% off. What else? They also tell you about if you're buying news or if you're paying for certain things where you can get the discounts. So if you read into this, they actually tell you exactly how you can use your card to basically buy the things that you normally would buy. And that's basically that. They have a very, I like good graphic user interfaces. So when I see a really good graphic user interface, that attracts me a lot. And I think, okay, this makes it easy for you to understand what you owe. But as you can see, my strategy is to never owe anything. So, I don't have to pay them. And let me move on to this. So this is my iPad right here. Let me move on and show you the loan calculator. I'm going to share the link again for everybody. And I've shared this link before for the loan calculator. Loan You Later is just a mortgage calculator, and it allows you to calculate interest on any loan. So, for example, if I have, like my friend, if I have $100,000 of student loans, and the interest rate is a 6%, I'll just leave it as 6%. And my monthly payments, now notice you need 3 out of 4 values to do a calculation. You need 3 out of 4 values. So if my monthly payments, let's say if I'm only paying them $200 a month, then it gives you the 4th category, and it says number of months it's going to take you to pay this off. The calculator doesn't understand it, and the reason why is because the total amount paid would make your interest negative. So they're saying that there's something wrong with this. So what I'm going to do is I'm going to increase it. I'm going to say, okay, I'm paying $1,000 a month. All right. So I'm paying $1,000 a month. Number of months, as you can see, 139 months. Now, when we mention this term amortization, first of all, let's understand, if you have $100,000 in student loans like one of my friends does, it's going to take her 139 months at $1,000 per month to pay this off. And the total amount of interest she pays will be $38,975. The total amount she will have paid is $138,975. So for you taking out your student loan for $100,000, you're going to pay back almost $139,000. And that's assuming you don't have late fees and finance charges. That's an assumption because chances are you're going to slip up. And if you slip up and you don't make your payments on time, well, you're going to pay $140,000 or more. Now, as far as amortization, what the banks do is they have what's called an amortization schedule. They do not equally take your money that you pay them and disperse it between your principal and your interest. What they do is they make you pay them their interest up front. And as we're making all these payments, the amount of interest gradually goes down until eventually now you're only paying principal. So by the time you're at the end of this loan, the majority of your money will be going towards principal. However, in the very beginning of the loan, the amortization schedule shows you that for that $1,000 payment you make, $500 is going towards interest, $500 is going to principal. So that's the reason why there's some people who make payments regularly and they don't understand why the loan doesn't seem to be decreasing. They assume that if I owe $100,000 and I pay $1,000 a month, that every month I should see the loan decrease by $1,000. That's not how it works. The amortization schedule shows you just how many payments you're going to make. Somewhere in the middle, let's say payment number 100, you'll be paying $180 or so towards the interest. and $819 towards the principal out of your $1,000. But as you go back, you'll see that more money is going towards the interest. So in this case, you're paying $598 for principal, $401 for interest. So once you understand this, how this amortization schedule works, it allows you to calculate just about anything. Let's say I want to buy a brand new Hellcat, $80,000. Well, in fact, that's a really high number. So let me say I want to finance a used Hellcat, $55,000, and let's say that they want to put me on a schedule that is 74 months, and the interest rate is a 3% per month. That car is going to cost me $815, and by the time I pay it off, it'll cost me $60,000 because $5,000 goes to the interest. Okay, it makes sense. The amortization schedule automatically recalculates, and it shows me just how much every one of those used car payments is going. What it doesn't show is how much you're going to pay in maintenance, gas. The brakes on that car are $1,000 for a rotor, and they're $450 for brake pads. So they can't show you the maintenance costs, but what they can show you is the breakdown that the bank is giving you. And last but not least, let's say I want to buy a house, $300,000 house. The term is probably going to be 360 or a 30-year fix. So that's 360 months. Let's say the interest rate is at 3%. Monthly payments are going to be $1,264. The amortization schedule will show you how the payments are broken down. What this doesn't show you, this does show you the mortgage, but what this doesn't show you is the cost of tax and insurance, because you have to have insurance in the house and you have to have taxes being paid for in escrow, which means that you're going to probably end up paying this is $1,264 for a mortgage, but chances are you'd probably be paying $2,000 a month for that mortgage. A $300,000 a month mortgage is actually not that bad if you could get it at a 3%, which is the reason why so many people are buying houses right now. Now, some people want to pay off the house quicker, because I want you to notice something. The total amount that $300,000 house is going to cost you is $455,000. So at the end of your payments, you will have paid $155,000 more. So what some people try to do is they'll try to get a 180 month, which is 15 year. So 180 months. Usually it may carry a lower interest rate. However, for sake of argument, let's say that the interest rate was still 3% at 180 months for the same $300,000 house. By the time you finish paying it off, the monthly payments will be much, much higher because you're paying more money quicker. However, instead of paying that $155,000 more, you'll be paying $72,914 more, and you'll have only paid $372,000 instead of paying $155,000 more than the $300,000. And the last thing, some banks will offer you right now a 20-year instead of the the 15-year. I believe that's 270 months off the top of my head. The monthly payments drop down to $1,529, way more affordable. The interest rate is only $412,000 you're paying after all this time. So instead of paying $155,000, you're only paying $112,000. And again, the amortization schedule shows you exactly where every payment goes. And the reason why I like this loan calculator is also because it also has an investment calculator. So if you're the type of person who doesn't know how to run investment numbers, if you feel you need to, it also has an investment calculator that allows you to calculate monthly additions, and it also shows you total contributions. So this loan calculator, I'm going to put the link there in this back chat or whatever, so that you can download it if you haven't already. As far as I know, this only works on iOS, so it works on iPads and iPhones. Okay, so it's called Loan You Later, and I'm going to share that in the chat right now, and I'm also going to put that in the video description. Anything you'd like to say?
I wanted to tag back on something Craig said earlier about how the amortization schedule resets when you might refinance. So maybe we could just say a few words about that, a little bit about if there's any concern with if you need to reset the amortization schedule, because obviously it's changing kind of the terms of your loan sort of entirely if you're refinancing. So are there any concerns with changing how the amortization schedule might be? Or I would think that it's sort of better if you get a lower interest rate, and even though you're paying, whatever fees are associated with getting that refi, in the long term, even if you have to reset your amortization schedule, I would still think that you're hopefully still saving, because from that example you shared, from not having to pay 155,000 in a 30-year, and you were only paying 72,000 in a 15-year mortgage, you're saving $83,000 or 53.5%. And I did that calculation while you were showing us your iPad. Like, that's a huge savings if you can, refinance to a lower rate and do a quicker mortgage than just, I know you're using 3%, but if you can do, both those things. Like, I've heard of people getting originally a 30-year, but then when they feel like they can make more aggressive payments, they switch it and refi to a 15-year and then have a lower interest rate amount. And then even though they're paying higher for now, it's because you're really tackling your principal on your mortgage, and therefore you paid off much sooner and you saved yourself tens of thousands, if not hundreds of thousands of dollars in the long run.
My uncle recently, when these interest rates hit their all-time low, my uncle has 3 children. All of them are basically toddlers. I think the oldest one is like in second grade, maybe, if I'm not mistaken. And they have a really nice, big, beautiful house. And what he did was he went from whatever his first mortgage was down to a 15-year. And his reasoning was, if I go down to a 15-year, by the time my oldest kid is 18 years old and has to go to college, this house is completely paid off. So this way I don't have to worry about paying college bills, and I don't have to worry about simultaneously paying a mortgage. The only thing he has to pay is $13,000 a year in property taxes and whatever other expenses they incur. So one of our biggest problems, I'll say, as millennials, is that a lot of us have been forced, because of the economic conditions, we've been forced to wait longer to purchase a property. A 30-year fixed mortgage is usually based on the logic that you're going to marry in your 20s, you're going to stay married into your 50s, and by the time you're 50, 55, you'll be retiring, and your house will be an asset rather than a liability. And you'll also be at Social Security age, and you'll be getting a pension, so that even though you're not working anymore, your house should be paid off and it should now be an asset. And on top of that, you should be getting enough income from whatever you've saved, plus your pension, plus your Social Security, to be able to survive. Now, we all know that that's not what's been happening. A lot of older people have been refinancing their mortgages to pay medical debt. Some have done it to pay student loans. We know that a lot of people have gone deep into debt in order to keep up with the Joneses, with the luxury cars, or to just spend money on frivolous things. So a lot of people, besides the fact that a lot of people have been waiting longer and longer to start a family, and they're starting families in their 30s rather than their 20s, that's one of the reasons why the 30-year mortgage is more affordable over time. However, it's neither one of these mortgages is feasible if you're starting a family or purchasing property later in life, which is one of the reasons why I say, for the people who think that they're just going to save up cash and chase inflation, doesn't make sense, because your money is gradually worth less and less and less as time goes on. So you're almost better getting the mortgage now. And strangely enough, the longer it actually takes you to pay off the mortgage, technically the more you save, because your money itself is still paying that same, whatever that mortgage amount is, but your money itself is worth less. That's so when you really do the numbers, strangely enough, these longer term mortgages actually cost you, strangely enough, they cost you less. However, the safest place to be is a 15 or 20, because you can pay it off as quickly as possible. You can get aggressive as quickly as possible. And this way, just like my uncle, by the time your kids are grown, you don't have to worry about a mortgage. Now it's an asset. If you need to sell it, move to something else, you can. Maybe something cheaper, in another state where the taxes are lower. So there's a lot of dynamic things that go into this. None of
Yeah.
us know where the economy is going to be 5 years from now. Nobody knew 3 years ago. Nobody knew in December 2019 that the world would be in pandemic for 2 years. Nobody knew. So we have no idea what it's going to look like 5, 10, 15 years from now. So the best thing you can do is prepare yourself by improving your credit. And once your credit is improved enough and you have a stable enough job, purchasing property.
Right.
Michelle.
I'm totally with you. And like, I'm trying to save up for a down payment toward a house at some point. So I'm all about trying to also get real estate and a house. So I'm trying to get there. But like, on the flip side, I just want to say for people who are renting, a way that it can be justified is if, like, sometimes in expensive areas, the property taxes are a lot. Like you mentioned, your uncle, I think, has $13,000 a year property taxes. That's a lot of money.
He has over an acre of land,
Yeah,
and it's a big, 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 big property.
that's awesome. Well, like, so that's great. But on like the thing that people also got to think about is like, you have to add like the knowing the mortgage payment and interest that you're gonna have to pay for is one thing. But then you also got to calculate if you plan to live in that property for the whole 30 years that you might own that property. Think about how much your property taxes will also be. Like if you live in a very low property tax state like Pennsylvania or Wyoming, maybe it's a good deal. But if you live in more expensive states like California or New York, New Jersey, Connecticut, like it might be, something of a substantial cost to try to factor in. And then you have to add that into your long-term costs of what it will really cost you to live in certain locations. And that could be a big deciding factor between whether you want to own or rent. And depending on if you're trying to rent for the long term, like renting can be beneficial if you can also invest the difference that you're saving from not having to pay property tax. And if you're able to invest it instead in the stock market or other kinds of ventures or in businesses and you make more money that way, you could get by with just renting. Like I know some people who are okay with not owning a house because they don't want to have to deal with the house insurance or the wow, that's so cute. And they don't want to have to deal with the property taxes or whatever the high cost of living that there might be sometimes with owning a house. And that house looks amazing. So I think your uncle did well by
If I showed you the photos of what it all looked like before he did all the renovations, basically the entire, because in Long Island a lot of people don't take care of their houses because it costs them so much to live there that they're just living there and they're not doing upgrades. He basically rebuilt this entire house. Now he didn't change the layout or anything, but again, this house is really big. In fact, I don't know if I have a photo because he has a garage that is literally the size of some smaller houses. And yes, it's a very large front yard, and his backyard is basically the same size as the front yard.
wow.
So it's a lot. The property taxes here are obscene. And again, he's what is it? He's 53 going on 54, and his wife is 14 years younger, and they just had 3 kids within since 2011. So again, in his mind, he's like, I need to pay this place off as quickly as possible because once this bigger kid gets to be 18, I don't want to have to worry about a mortgage anymore.
Right. Yeah. Or he's got to tell the kid to get as much scholarship money to afford college. Like if you still have things like debt overhanging. Like it's a tough balancing act for. Like I admire parents tremendously. If you're trying to do the balancing act between affording your mortgage and your college kids' education, like those are big ticket costs. And I think like part of why we're in such an like kind of epidemic of debt is because not enough people, both young people and their parents, didn't always think enough about how much it's really going to cost the family. And if you have multiple kids, it's expensive. Like even if you go to state school, it still is a substantial financial burden both the kids and the parents for people to just live and then be able to go to college if that's what you want. So it makes sense. A lot of people are trying to find alternatives, like they want to like not have to pay for an expensive 4-year college, so they try to find ways to save there, or maybe live in an area that might be kind of more rural, but maybe you save a lot more. Like, I know people want to live near New York City, but if people live in upstate New York, you could find like places that are a reasonable place to live and it doesn't cost as much, for example. Like it could be done. So it all depends on people's priorities and what they value and where they want to be. But if you have the luxury of working from your home and you can have fast internet somewhere, like it's no wonder that a lot of people are moving to more rural places so that they can have a better like way of living and not pay as much in property taxes or for their house, and be able to have more money that's coming in to afford other things. So you got to obviously look at what's right for you, but we don't all have to just take on endless amounts of debt. There are alternatives to still being able to get just as good of an education or still be able to have a good life and in a place that we want to live in. And it doesn't have to cost as much money as like unfortunately a lot of places are right now. But like we'll see where those places will emerge. Like all of a sudden you'll see places popping up that become more and more popular to live in. And I'm sure everybody has seen that like smaller mid-sized cities are growing because they're just more affordable to live in, and they offer incentives for people to become homeowners there, and they save a lot of money by either not having state income tax or low property taxes. So that's going to be happening more and more, I think.
Yeah. So again, I know we've been on almost 3 hours. It kind of didn't even really feel like it. So I guess within the next 5 minutes, we're gonna try to wrap things up. Now, I don't think you always make videos. You've never tried this format doing StreamYard and inviting people on in order to talk about the stuff that you're talking about, like like the books you've read and stuff like that. But you should really consider checking out StreamYard. It's free to use. They give you you're allowed to have 6 people to come on and ask questions, or kind of like a call-in show. And once you learn how to use it, it's actually really, really awesome, and it would probably also help build your channel.
Well, thank you, John.
Yeah, you should consider it. I put a couple of people on. Obviously, I put my father onto StreamYard, and he's loving it so far. But that it might help you to connect with people who are reading the same things that you're reading, or people who are interested in doing this type of back and forth.
Yeah, you're right. It's definitely a good idea, and I just haven't yet explored it as much. Like, gotta find people to also talk to, I guess. So I'll check it out.
So I know it. What is this? 9:57. Here's a question: are you ready to wrap up, or would you want to entertain 1 or 2 questions from anybody who has like a serious question that they didn't pose? Which one do you feel like doing?
I'm happy to answer questions if you still want to be on.
Okay, yeah, because we're gonna wrap this up quick. So what I'm gonna do is I'm gonna drop this link. So guys, if you have very, very specific questions that you think can be answered relatively quickly, I just dropped the link here. I got Ramil said, "What's up? What's up, Ramil? How you doing?" So I dropped the link here just in case you have some very specific questions if you want to come up, because I'm not going to monopolize Michelle's time, because I guess you have to work tomorrow.
Yeah.
Yeah, I got something to do early tomorrow too. In fact, tomorrow's my birthday, and it's going to be a long day. Thank you, thank you, thank you. So if anybody has a very specific question and it can be answered, you can come up. If not, I'm going to get ready to shut down. And let's see, this is the one by the radiator. No, this is this guy. No, this guy is. He's
what question is that?
No, you don't even want to. But anyway, yeah, if anybody has a, all right, okay, we got Mel showed up. Mel popped up, so we'll take a couple of questions, and then I'm gonna let you go. So prepare for tomorrow. Mel, how you doing?
What's good, Big Truck? How's it going, man?
What's going on? How
Yeah,
did you appreciate the stream, and how did you appreciate Michelle's advice?
I kind of watched bits and pieces of it because I was back and forth doing something. So I watched the replay and stuff like that. Definitely, but it definitely caught some good information. I do have a question though when it comes to because I'm working on cleaning up my own credit right now and everything. The main part I'm mostly focused on is just the charge offs and stuff.
Charge-offs. Okay.
Yeah, and stuff. And
You got
when
a
it comes,
specific. All right. I'm sorry. Go
yeah.
ahead.
Oh yeah. When it comes to charge offs, I do have some charge offs I want to get rid of. What's the process trying to, can you actually try to, I hear so much different strategies that you can still get it erased off your credit, even if it's charged off or something like that. And, you know, by trying to prove that it's yours, validation, and all that stuff, yeah. So I just want trying to find out if I'm, the process is right, or something like that. Like, what's the process?
All right. So first of all, just so everybody understands, a charge-off means that the lender or whoever the credit was given by has written your account off as a loss. That is bad for your overall credit history. That is bad. It's not the same thing as bankruptcy, but it's bad. Now that also means that you're still going to owe the debt. Now here's a question: Are you?
Oh yeah. That's another point. I'm sorry, because that's another thing. I heard about when charged of they sold it to a creditor, right? It was charged off, but some of the charges in my history it's not sold by the they ain't sold to no creditor, so it's still owned by the company that charged it off.
Is there a way? Is there a way that you can pay it off? Like, is there a way that you can avoid having to do the charge off because it's bad on your credit?
Yeah, it's been like that for years. Yeah, like there's a couple of charges there. It's been like that for the past like couple of years. It's not within the seven. I probably got like 2 more years till notice.
All right. So let me say
so
this because you specifically asked about how to get rid of a charge off.
yeah.
Something called a pay for delete arrangement. You basically still owe the debt, the original debt that would have been charged off, but you can pay money to delete it from your credit.
Okay. Being that they sell it to a creditor and they still own it even though they charged it off.
Right. And you have to inquire with them about a pay for, this is exactly what you asked for. A pay for delete arrangement.
Okay.
Okay? Thanks. Let me move on to the next guy.
Right. Thank you, man.
You're welcome. Okay, Wizard, how are you?
I'm doing well, and yourself?
Very good, very good.
Okay, this was a very nice stream. I learned quite a bit. I just had a quick question. I want to know if whether any of you two were you participate in option trading as an alternative. I mean,
No.
no.
No. Options trading is so risky. I don't bother with it. I specifically go after dividend stocks and real estate. Real estate is, in my opinion, is better than even the stocks are, but real estate is probably the best possible hedge. Options trading is so risky that you can end up owing way more than you even put in. It's like, nah, I don't bother with that. Nope.
Okay.
I don't think Michelle does either. Go ahead, Michelle. Michelle, you're muted.
All right. So this is what I'm going to say. If you really want to explore, like, I don't know if anyone, skis or snowboards, but this is like entering double black diamond territory. So that's like the steepest, most hardcore place you could be going on a ski mountain. So just be aware that if you try to wander into the realm of options, you better be as knowledgeable as you can to try to like figure that out. But if you still want to learn of how you could do it, like there's actually this investor that I admire and respect a lot named Phil Town, and he teaches people how to do options trading. Yeah, if you've heard of Phil Town. So like look into his website, Rule 1 Investing. He's all about the Warren Buffett style investing. So like all about normal, really good investing for the long term. But in addition, if you're trying to make money in the short term and if you really want to put effort into learning how options trading works, I suggest Phil Town and some of what he does because that's how I learned how to do some options trading. I don't do that much of it, but I know what needs to be done and there are certain rules that you need to go by. So if you want to take this up, like take it up like you're learning a discipline, like you're trying to become a black belt in karate or taekwondo. Like you got to be willing to have the discipline. So maybe check out some of that. But yeah, be careful if you are trying to do some options trading. It's not for the faint of heart.
Okay, thank you. Because I do a little bit of option trading, but I'm looking at some forums and whatnot, and a lot of these guys have a lot of success in doing option trading with ETFs. I'm wondering, like how to do that, like the strategies behind it. So thank you. I'll look at a reference.
All right, good luck.
Thank you.
All right, thanks a lot, Wiz. I'm going to remove. All right, I got Ramil and Ron. Ron, you were first. So, Ron, what's your question?
What's up, Truck?
Oh, how you doing?
Not much. So I've been in the military for like 2 years, and I got like a VA loan at my disposal. And I live in Phoenix, Arizona. And I was wondering, like, what is like your what do you think as far as the market right now, the buying market and the selling market? Do you think the buying market is going to come up in like 1 to 2 years? Because that's about the time I have left of being at this base in Phoenix. And I was wondering, shall I use my VA loan to probably buy a house within the next year or so? I don't want to get fucked though. So,
well, I'll say it like this: first of all, if you're lucky enough to even be able to find a property that you can buy, that you can afford. Like if you can, go ahead and get it. The VA loans are being very friendly to veterans right now. In fact, VA loans allow you to stretch payments out to 40 years because they've allowed. Now, granted, I don't recommend that because what that basically says is you're in financial trouble and you're stretching out the term of a payment so long until you're going to end up paying for that house twice before you pay up. But it's just one of those things that's optional right now. So I would really, if you could find a property and you can afford it, especially if you're married or something and you've got dual incomes coming in, go ahead. But I would try, if you could, to go for the 15-year fixed at a 3%, or even if you have to, the 30-year fixed at a 3%. And possibly down the road, I won't say for sure, but possibly you may be able to refinance to lower it down. I personally do not see the Federal Reserve lowering interest rates any more than they are now, simply because this is quantitative easing infinity. I don't think we're ever going to see anything lower than what we're seeing right now. I really don't. So,
and I want to just throw out there for you, Ron. Thank you for your service. Appreciate that you're a veteran. Thank you, or when you are no longer in service, but thank you so much. And I also wanted to say, if you're worried about like say you're gonna move away from there, like maybe what you could think of it as also as an investment property. So if you find something that you like and you think you can afford the payments, you could think of it as maybe you might want to rent out another component of that house if it's rent outable, or if you want to do Airbnb. I'm not saying that you should, but if you want to treat it as an investment, some people do what's called house hacking, and so they rent out a part of their house to someone else. So you could also be making money with someone kind of renting from you at the same time, and that can also help go towards your mortgage if you don't mind kind of also doing the landlord thing. And if you might be moving away from that area, maybe you might want to see if there's somewhere else that you might envision yourself living in for the long term. Like if you can take advantage of a loan somewhere else that you envision being in 7 to 10 years, and if it might not be that area that you're in now, maybe it's better to wait until you find your more, forever. And when I say forever, it doesn't have to be literally forever, but that you could see yourself being in for like at least 5 to 10 years. And then maybe it might be worth it to commit to something like that. And like John said, probably interest rates will stay kind of lower. Like even if the Federal Reserve raises the interbank lending rate, which is what a lot of it tends to go by, it's between 0 to 0.25% right now. And even if it goes up like 0.5%, like that's not all that much. And they might raise it only in late 2022 or early 2023. So you still have a couple of years where we should continue to see pretty low interest rates. Like I don't think we're necessarily facing like really high interest rates on home mortgages anytime soon for the next few years. So with knowing that, if you can find something that's affordable, like John said, maybe it's a good time to try to get something, but you're also, I don't know, not in a bad shape either if you want to wait a couple of more years. Like I think, like I could be wrong, but maybe housing prices will cool down the more that things kind of normalize, because, if you also think about, we're coming out of a big economic stressful situation with the pandemic. Like if more housing supply comes online in the next year or two, maybe that will be easier to buy a more affordable house. So that could also be something to look forward to, because I think the Wall Street Journal reported that starting in April and May, like housing sales started declining just a little bit, which means that there's not as many people as like, bent on having to buy houses at all-time prices. So maybe like things will start normalizing a little bit, but like see what makes sense for you and your situation. And if it's a good deal, then it might be a good time to get something if you can.
All right.
Okay, for the I'm sorry, Ron. Go ahead. For the last two guys, we want to make it as quickly as possible because I've monopolized Michelle's time. But go ahead, Ron. Go ahead and finish up.
Oh yeah, dude. All I was gonna say
All
was
right.
thank you guys for your
So
input.
John and Michelle.
Oh wait, El Seth, Ramil was gonna go first, and then I got you, and you're the last guy. Ramil, go ahead.
Thanks, Ron.
Okay, yes, I have two quick questions. First one for John. John, do you know a good my radiator seems to have been broke. Do you know a good HVAC person who can come
I recommend the Home Depot credit card #1. And as far as HVAC goes, we have a lot of guys around here, but they're mostly
they got to specialize in radiators though, not just
yeah. They specialize in HVAC in general. But if you're looking for ironworks, we've got guys who can custom make you a beautiful, beautiful radiator. And they look great. Anything about the housing market?
Oh yeah, okay, yeah. So I got a quick question. So about the credit thing, real quick. If I have $10,000 in cash and I want to get a car that costs $10,000, am I better off getting it in cash or getting it off the credit card?
Well, if it was me and I have $10,000 in cash, chances are I'm going to buy whatever it is on the credit card, and then that night I'm going to pay it back on the with the cash. And the reason why is because I'm capturing the rewards points, and I'm capturing whatever. How
many rewards points do I get? Is it worth it? Because I keep hearing about rewards, but why did I buy the cash?
I'm going to let Michelle answer that one. Go ahead.
I want to jump in. So I'll tell you this because I did this. So I was at a car dealership buying around the $10,000 car, and I wanted to charge the whole thing to my credit card so I could get the reward miles and points. But then they were like, no, you can only charge like $2,000 or $3,000 to your credit card, and the rest, we'll take cash. So like they refused to let me charge the full thing in a credit card. So you got to see what you can kind of get away with. Like I tried, like I was about to do the exact same thing that John did, or John would do, but they made me pay the good chunk of it in cash. So, if it also depends on what you're more comfortable with living. Like, can you pay off that balance on time and ideally in full? And, or you could take advantage of a 0% APR for 12 to 15 months. Like I've done that before. So see what you're able to do. Like if obviously the best is to try to get the best of both worlds, like get the rewards points and miles if you can, but like do the next best thing, which what happened to me was like I could only charge $2 or $3 grand of it to a credit card. So I still got some points, and so the rest of it I had to pay in cash.
All right, thank you. Elsef, what was your question?
I appreciate it, man.
All right,
Thank
John
you,
and Michelle. I really say that I'm gonna start watching Michelle's channel a little more. But for John, both this on the stream today, y'all teach us stuff that they do not teach us in school. I have a lot of valuable information from y'all. Thank y'all very much.
Yay.
And now when I get older and when I get my credit card at 18, I know not to make those same mistakes.
Good.
All right.
Do you have a question, or did you have any questions?
My question is, should I no, because my 18th birthday is October this month. I was thinking about giving me a $1,300 phone for my birthday. Should I put it on my credit card and pay it off in cash the next day, or should I just improve my available credit, Bank of America? Because my mom has a big America account. I was thinking about putting it on my mom's card, or should I get my own card? Or do you think that's a bad idea?
So it depends. So when you get your first credit card, it usually doesn't have a high available credit limit. So, and then also think about how, okay, normally if you apply for a credit card, it could take you like, it could take the bank issuing it like 10 days to give it to you, like over the course of, like, as soon as you get approved, they'll be like, okay, you'll get in the mail. And it could take 7 to 10 business days for you to get that card in the mail. And there's actually a little trick where you can call them and be like, can you actually expedite it? And usually they do without like charging a fee. So, it depends on like how you're trying to time this is when you get the credit card and when you're trying to make the purchase. So just keep that in mind. It can sometimes physically take like up to 2 weeks to get the card in the mail. But then also, since you're starting out with a low credit balance, like on the credit card, it might be a little bit tricky if you're almost maxing it out. Like, let's say they only give you $2,000 credit limit, and sometimes it's even lower. Some people only get $500 to start. So it will be sort of not recommended to try to charge something that's over 1,000 on a only $500 credit limit. It can be done, but like I don't think you might get denied, or it will just sort of put your utilization really high. But maybe if you pay it off right away like John would do, maybe you could do it. But maybe what you might want to consider is have your parent add you as an authorized user to their credit card, because more than likely they have a multi-thousand credit limit. So it's not gonna, it probably shouldn't dent their credit score too much. And then it can help start building your credit if you're an authorized user on their account, as long as you're responsible for paying for, any of your charges that you're doing.
Excuse me, another question.
Okay.
My mom is trying to buy a house, but she got declined on the Bank of America MasterCard because her credit is too low. And I'm trying to help my mom build her credit, but I can't at the moment because I lost my job due to something that was crazy.
Oh,
So I'm saving up all my money I can, but I don't really think I'm gonna be able to do that right now, because if I want me a credit card, I'm not getting me one right now because I don't have a job right now. But I do have cash in person though, cash on hand
So
to
yeah,
use what I need to use.
like if your mom's credit score is a little bit on the low side, it may or may not really help you, because if she might be trying to like do her own loans and stuff, and then you get added as an authorized user, and then even if you charge something that you pay up right away, it could, for whatever temporary amount of time, increase her credit utilization, which, depending on the timing with trying to get mortgage loans and so on, it may not look good. So if she's also trying to improve her score, it might not help either of you if you try to jump on her bandwagon credit situation. So you might be better off getting your own credit card. But the other thing is, even though you might not have a job now, if you think you're going to get a job soon enough, like hopefully within the next few months, like they will ask just a question like, how much do you tend to make a year, like your annual income? So you put what you think it is, and if you think within a reasonable amount of time you'll be able to get a job again soon, and you think you have an idea of how much your annual income usually is, you could put that down. Like it doesn't usually factor, in my experience, if you have a job right at this moment in trying to get your own credit card. So you might be better off getting your own credit card. And what you could also consider doing is, let's say you apply for your own credit card, which I still recommend you do. If you're turning 18 soon, I did that. As soon as I turned 18, I opened my first credit card. So definitely try to do that. And then what you could do is, if you end up having a smaller credit limit, you don't have to charge the full value of the phone to it or whatever you're buying. You could just do a partial charge, so that, like, sure, you can pay it off right away, and then maybe the rest of it you have to pay in cash. So you could still start getting the best of both worlds, as long as you can fully afford what you're buying, and also make a plan that you're paying off your credit card balance, ideally in full and on time every month. So that's what I would suggest, is like you might actually want to just get your own card.
I'm not that type of person that likes paying his bills halfway. I prefer to pay mine within the 30 days after I get that bill. I do
Okay.
not play around with my money. I'm a very serious person, and everybody in my house knows this. When I
Good.
have money, I don't spend it on any unnecessary stupid stuff. I only spend it on stuff I actually need. If I see something I want, I save up for it. I don't need it right away. Like I want me a $1,300 phone. Like I've asked you, should I get it? And I'm waiting because I don't really need it right now because my phone was just fine. I got me a computer from my college. So and by the way, my college is getting paid for. I don't have to worry about that at all. I have that situated.
Good job. Well, yeah. So see what happens. Like I don't know how much of a credit limit you'll get on your first card. You know, if you're lucky and if it's $2,000, then great. Like then, you know, why not charge the full value of the phone to it and then you pay it off within the 30 days? Like then you did well. Then it's fine. So I think since it sounds like you're a serious person and you're disciplined, like I think you're on the right path.
Yeah, because I am because my dad would not play. My dad would not let me play around with his money. Every time I would play around with my dad's money, my dad would beat my ass. So I'm disciplined. I know what to do and I know what not to do with my money.
Good. Okay, I'm glad to hear that. I think you're fine then. Hopefully you get a good start in being able to build your credit, and then in the future, you know, when you have a job again and you're making everyday purchases like grocery and gas and stuff, like the more you build your card, and then let's say you open up another card like in another year or two, and then you know you build more credit because now you're showing like you're responsible. You always make your payments on time and in full, ideally. So then you start building more and more credit. Like, so I think like, and you build not only the score, but also the available credit. So I think you're good. I think you sound like you're going to make the right choices. So I'm happy for you.
Oh, I am because I don't need a luxury phone. I'm stuck with my little bullshit ass iPhone 7. I could have upgraded, but I'm not upgrading because these damn phones cost way too much. Or I was thinking about getting me either an iPhone 12 or either a Galaxy Z Fold 3, but those are
But now
those are
let
over
me
my
ask you
price limit.
let me ask you a question. Let me ask you a question. Do you think that maybe you should wait until you have like, you know, income stability first, because a $1,300 phone is a bit expensive?
It is, so that's why I'm waiting. That's why I'm not doing anything right away.
Or buy it on eBay for cheaper. Like, see if you can get it like for half of that, like 700 or $800, like also new. Like that's what I would do. I bought my phones on eBay. Like that, I love eBay.
Yeah, I love it. I absolutely love eBay. I see. My thing is again. This is what we're talking about when we're saying about being careful about frivolous spending. Unless your phone is earning you money, you might want to consider spending that kind of money on a phone. My phone pays for itself because I use it in vlogs and stuff and business, and it makes its own money back. So that's something you want to consider. Do you really need something that expensive? That's the thing.
That's why I said earlier that I don't need it right now. That's why I said I'm not getting it right now.
Yeah,
Okay.
also, I just want to say that ain't no shame in using an older iPhone. Like I still use an iPhone 6. And
What?
I use an iPhone 7. What?
I use an iPhone 6 on purpose because it still has the headphone jack.
Oh
yeah, I like that. Yes.
You gotta graduate, Michelle. You gotta graduate to the digital, all digital music. You gotta get away from that analog.
Well,
iPhone 6.
I've heard some questionable things about like, you know, too much Bluetooth and like radiation. So I gotta do
Nah.
Oh hell no.
and I have heard that a lot of people never went past iPhone 6s specifically because of the headphone jack. But I'll say this, especially when it comes to say going to the gym or not having to worry about that cord getting ripped. I prefer the
But I've also known some people who lost their AirPods, like, and those are expensive.
Well, AirPods are a terrible headphone design. Now,
they fucking suck, honestly.
The ones that are wired, the ones that are earbuds and they have a wire connecting them, like the Skull Candies, those are like less than $20, and they'll work on any phone. They'll even work on your iPhone 6 because they're all Bluetooth. That's the kind that I like using. Earpods don't make sense to me, and Apple, they're good at marketing. They got a lot of people to buy that stuff at those prices.
Yeah.
I never purchased them.
So,
Go ahead. I'm sorry.
I might do that too. Like, don't get me wrong. I actually own an iPhone 10 also, but I actually prefer using my iPhone 6. But like if I upgrade, I was actually thinking about the iPhone 12 too. But if I do get that, maybe I'll get those Skull Candy because I've had like wired Skull Candy before. But like if it's only like $20 for like basically almost a wireless Skull Candy earplugs, like that sounds like a pretty decent deal.
Yeah, no, they're cheap. They're about $15 on eBay. I think
They're
I
really
might have
cheap.
paid about $18 in a CVS, but on eBay they're between 10 and 15 because they have the Jib and then they have the Jib Plus. I had the Jib Plus. I think I paid about $16, $17.
I brought the Jib Plus for $25.
They're very good.
I got those for $25 at Target.
Yeah, first, I like having the buds because the buds stick in my ear and I don't have to worry about them pulling out just by brushing my hand next to my head. And the problem that I have with EarPods and any of those dual beam headphones, because everybody tries to make the dual beam where it's just one and then one, there's no connecting wire. The problem that I have with those is the recharge rate. You have to keep recharging them and sometimes they don't charge symmetrically. Like when you charge the connecting wire model, you charge the battery and the battery supplies power to both. The problem is with dual beam, sometimes they don't charge equally if the case is low on power. So I don't deal with iPods. I don't deal with them. And I also heard that the ear pods that were $250, I heard those were terrible. I heard that they had a lot of issues with those.
AirPod Pros are not what? AirPod
Yeah, I heard that they had a lot of quality issues with those.
Hell no, those are good.
No, I heard that they had a lot of. Yeah, I heard they had a lot of quality issues.
Oh no! Excuse me, I've been hearing good and bad things.
Well, look up the reviews. Look up the reviews and look at the positives and the negatives. I tested them temporarily, but I've heard a lot of issues. Furthermore, I'm not paying you $250 for earphones. That's it.
I'm not either, but like I love Apple and Samsung, but I'm not paying top dollar for any product.
Yeah, exactly.
There you go.
That's how you got to think about it.
I'm not doing that. I could do it, but my mom would kick my ass. I say that right now.
Okay. All right, Elseth.
My mom's money, it's not mine.
All right, Elseth, I'm going to drop you down now because I don't want to monopolize Michelle's time too much. So thanks for your question. And
thank y'all for your time and thank y'all for y'all lessons.
You're welcome.
Please like and subscribe.
Like and subscribe. Thank you.
Already did. This was worth the whole 3 hours.
Good.
Through 3 hours. We're almost going 3 hours, 30 minutes. I'm trying to reduce it. I'm sorry. What were you going to say, Michelle?
This is like a football game. We're like, we can compete with the NFL.
It's like almost like a job. Sometimes I've gone for as long as 6 and 7 hours. It's like a job.
Really? Wow.
Yeah. Like it was back, like especially during the pandemic when we had nothing else to do. It would just sit home. Well, that's what I did. What were you going to say other than that?
Oh, well, not too much. I think that was great. Like, I really hope this has been helpful for most folks. And I know we stayed on a little bit longer, but it's been super awesome talking about people's questions. I mean, I think this is the best. Like, if people can be financially empowered, like, I just love that because it makes me feel good inside. And, as you guys can see, if you watch my YouTube videos, I'm not trying to ask anybody to buy anything. I'm not trying to tell you to go to some Amazon link that's like an affiliate marketing link. Like I know a bunch of YouTube people do that, but I don't care for that. Like I don't need money from people. So like, I just want the best for you that is to better your financial situation and help you be the best investor you can be. So I really do hope this is helpful to you guys. And yeah, like for sure, Bluetooth headphones are really cheap. Like the most expensive I've paid for like the overhanging Bluetooth type of headphones that are like, the old school style that are wireless, but actually you can plug in like a headphone jack. I only spent like $25 on that and that's good enough. So like it works. And yeah, like that's like one of the keys to life is spend less than you earn. And if you can keep doing that, you are bound to become wealthy. Like whatever you're bringing in, as long as you can save as much as possible, like that's how you get ahead. And then invest it in real estate or invest it in the stock market. like a combination of that. Like I think that's one of the better ways you could go.
I'll tell you like this iPhone 12 right here, great phone, great build quality, great. I buy these phones specifically for the camera. This is a 12 Pro Max. If iPhone 13 has the 1 terabyte storage, because this is only 512, so this phone was like $16.99 or something like that with tax. But if they offer 1 terabyte of storage, I'm selling this one and I'm moving up to the 13 because I need that storage battery. I need the storage capacity so that when I want to do my vlogs, because see, you use the Mac and you have probably more storage on your Mac, maybe. Because you use a laptop or so, you use like a Mac laptop.
No, I'm talking to you on a Windows laptop right now, but I actually use my iPhone X or iPhone 10 to record.
Oh, you have a 10.
So, and that one has 256 gigs.
Oh, so you keep the iPhone 6, but you have an iPhone 10.
Yeah. But I mostly use the iPhone 6. Like the irony is I use my iPhone 10 more for like video recording, but like at some point I want to get like an iPhone 12 Pro, but I'll probably not do the Max because that might be a little too big for me. I was about to say maybe you want to sell it to me at some point. Yours.
I was gonna suggest that because I'll tell you, my iPhone 12, the XS Max, I gave it to my mom, and I just gave it to her. I gave it to her with my old iWatch. She doesn't wear my Apple Watch. She wears my the Fitbit that I bought her for her birthday. But I'll keep you in mind because I keep myself in perfect condition.
A heavy phone. Like I don't even like holding my iPhone X because it's heavier than my iPhone 6 and
it feels like lead.
So I probably, if I get one, it's probably just going to be the 12 Pro, like the normal, not the Max. Like, so yeah.
I'll keep you in mind. I'll definitely.
Your phone is too heavy for me. It would hurt my wrist. So
but this phone right here, it's got like everything.
Oh, I bet. I'm sure it's good, but you'll probably make more money on eBay. So don't worry about me.
We'll see because there's going to be a lot of people. The how should I say, the market has shifted to the point where like almost nobody scalps these things anymore. It's like you just sell it, you get what you can get for it.
So do you trade it back into Apple?
No, because the value that they offer is too low. I had a 10s Max. I skipped the 11 because they didn't offer 1 terabyte, and then I bought this 12. So in that amount of time, they still haven't given us 1 terabyte. So what I did was I figured that their trade-in was so low, I might as well just give it to one of my parents. So a lot of my old Apple equipment, I do hand-me-downs, hand-me-ups, however you want to say it. I give it to my parents. So my father got iPad 4th generation Retina, and my mom got another iPad 4th generation Retina, and they both have like LTE. And I basically and she loves it. She's like, yeah, this is the best phone I ever had because up until then she was buying Galaxies. So,
you're a very good son. So your parents are probably very happy to have you as their kid. And
the best.
You're doing so well. Like I appreciate how you help so much of your family members and you look out for them too. And like I'm really happy to know you, John, and grateful to be your friend. So like thank you for having me on this live stream also. And like I don't know, like we're already over the 3.5 hour mark. So we've done an NFL game in terms of our live stream. I know like with the ads, like an NFL game will be 4.5 hours, but or 4 hours, whatever. But like this has been awesome. I hope everybody got as much out of this as I feel like I got. I learned a lot from you, John. So thank you so much also.
Yeah, you're welcome. So everybody, thank you for joining us. Both I and Michelle have stuff to do tomorrow morning. As for Kelvinito, I'll definitely do a dividend stock portfolio update. Probably sometime this week or something. Let's see what happens with the market probably tomorrow, Monday morning. So I'll definitely do an update there, and I'll talk about trends. So right now I'm going to end the stream. Thank you, Roscoe. Thank you, everybody that contributed. Thank you for the likes, the shares, the subscribes for both of our channels. And once again, we're giving out free game here and trying to help you win in the credit system. And
financial wealth through knowledge.
yes, spreading that financial knowledge. So I'm going to end the stream now. Thank you, everybody, for coming through. Got Holloway in at the last minute. Thank you, Holloway in. And everybody else, you guys have a great night and you guys have a great week. I don't know the next time we'll do a live like this or what the topic will be about, but last time we did stocks, this time we did credit. I don't know what the next one will be. Maybe it'll be something even more interesting, but it'll definitely be financial in nature.
I can always talk about investing. I love talking about investing all the time.
Yeah, no, me too. I love it. So thank you again, everybody, and I'm ending the streams. Good night.
Good night.